the good news in that is that you are seeing that broadening out of earnings.
What's happened with this AI trade is that we've extended the duration of equities.
I think the pressure on this market will resume.
You need bulls for bull markets.
The question is not, can you get good earnings for 1 or 2 quarters? The question is, can you get it persistently?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Wall Street bulls feeling confident after the biggest weekly stock rally since April, with J.P. Morgan the latest to upgrade its year-end forecast for the S&P 500. The next test for rates coming Wednesday with the release of key inflation data following last week's disappointing jobs print and oil prices steadying. If with President Trump semi-negotiating with Tehran and low-keying it in the face of ongoing threats.
Basically, right now, what it looks like is that this administration wants to continue to use economic power. We didn't hear the president escalate once again in a military fashion, but just saying that they're broke and inflation is very high for Iran. But in order for there to be really a sense of relief, the Strait of Hormuz has to open. And even though we are close to potentially having a deal between Iran and Oman, Iran keeps tying it to just things that the United States cannot agree on.
You know, it's striking to see 2 consecutive weeks of oil prices coming down significantly. The sense that perhaps we're past the peak in terms of tensions, even amid all of this. And that's really going to feed into the inflation print on Wednesday and then again on Thursday with PPI. A question of how much that's going to bleed into the disinflation that might bail out this Fed from having to actually move.
Right. Lower oil prices, all of this on the screen is definitely helpful for the Fed on Wednesday, which if Jonathan was here, I think he would say that's when the week really starts this week. It's going to be the anchor for the week in terms of everything is going to stem from this. It is incredibly important to this White House, and it is incredibly important to the Fed as they decide what they're going to do in September.
There's a lot of other things other than just that. If Jonathan were here, he and I would be arguing. Jonathan is off for the week, but he will be back the following week. That is kind of the key, right? That Wednesday and Thursday, PPI, CPI, and then PPI. Of course, we do get also bond auctions. I know that other people might say that they're not as interesting, but we do get 3s, 2s, 5s, and 2s, 10s, and 30-year auctions from the Treasury Department, which will be really important given the yield move we've seen more broadly.
Usually, maybe it's not as interesting, but I think this week it is very interesting. And not just that I'm sitting in your seat. I think this week it is interesting because you see the Treasury Department potentially have to borrow more so on the short end, and this Treasury Secretary who is concerned about rising yields on the long end.
Yeah, Treasury Secretary Scott Bessent making a point to talk about some of his efforts over the weekend. Right now, we are seeing in markets the sense of just this incredible exuberance taking a pause. Last week, we saw the best weekly gain going back to April 17th in both the S&P 500 and the NASDAQ, up more than 5% for the NASDAQ as well as the S&P. Today, building just a touch on that, up 0.1%. You are seeing the dollar regain just a little bit, not just versus the euro, but also versus the yen. We'll be talking about that coming up as the intervention from last week, maybe not having as much heft as some people would expect, not sticking around. 10-year yields inflecting up just a little bit after what we have seen, which is actually much lower benchmark yields. 2-year yields down 10 basis points last week. 30-year yields down 7 basis points last week. Let's see what the inflation data is actually going to show us. Coming up, Kennon of Clear Harbor Asset Management, with equities holding near record highs. Colonel Wayne Sanders of Bloomberg Intelligence as President Trump claims to be semi-negotiating with Iran. And Sarah Kunst of Cleo Capital as TSMC sales surge on AI demand. To begin this hour with stocks looking for direction ahead of more tech earnings. We also get that this week. Kennon of Clear Harbor Asset Management writing, investors are beginning to differentiate between companies simply exposed to AI and those capable of leveraging it to expand margins and generate durable free cash flow. Aaron joins us here in New York. Thank you so much for being with us.
Great to be here.
So let's just talk a little bit about some of the upgrades that we've seen. J.P. Morgan came out, the strategist said that 8,000 for year end. That isn't exactly a screaming buy, considering we're almost at their year-end target right now. What is it about the earnings season that makes people retain their bullish tilt?
Well, good question, Lisa. I think at the end of the day, we've seen massive growth, Q1 earnings, now Q2 earnings, even if you net out the extraordinary sort of Amazon and Google one-time aspect of the earnings, are still growing at well over 30% annualized growth rate. And it looks to me that, it looks like the market is suggesting as well that this AI revolution is very robust and is going to continue. That CapEx at $1.1 trillion on an annualized basis estimate is probably going to ratchet up again next year. and that we're going to start to perhaps see a shift in the momentum within the equity market, within the AI trade. And that's something that we're taking a close look at. Where's the return on invested capital going within the AI sort of stack? I think that's what the market's trying to decipher right now. A lot of the momentum in July has come back into the market, but there's sort of a question whether or not we're going to start to see more differentiation going on. How does AI impact the software sector? 2 months ago, it was called the SaaSpocalypse. And now we're thinking about the possibility that LLMs and the models, the cheaper ones that provide about 95% of what the greatest models provide today, may just be enough to be able to infiltrate the software companies and add significant value to those from an earnings perspective going forward.
Yeah, and 4 weeks ago, we were talking about the broadening out, not necessarily this concentration of performance in the hyperscalers and even the chip names. And suddenly we're back to the hyperscalers and the chip names. I mean, where are we going to go with that sort of toggling back and forth between who wins in this rolling ball of cash?
Yeah, well, I mean, it's a good question. Memory is still an extraordinarily high level of demand with limited supply. We think that's going to continue into 2027. But there's a question about momentum. And there's also a question when we look at the broader market where we're at essentially all-time highs as of Friday. The employment picture has softened on the margin, but remains relatively robust. I think, one thing we haven't talked about at the open is we have retail sales this week. What is the consumer thinking? We had McDonald's earnings last week that suggested a softening consumer. So what's the sort of countervailing force beyond the AI forces that we're seeing, which is a huge tailwind towards CapEx spending, towards a big component of the labor market, both engineers and people doing the picks and shovels. But what about the consumer in the lower quartile, lower half of the economy? We're going to get a read on that this week.
You mentioned memory sector volatility in your note. Is that a domestic issue, or is that really just a Korea issue?
Well, I think it's a global issue, from Micron to SK Hynix to Samsung to even the Chinese producers that Apple's trying to break into and be able to have them serve as a source of supply for even the iPhones, for example. And this has been ongoing. Eventually, we're going to have a normalization. It is a cycle. Is this a 2028 event, a 2029 event? I think the market's really trying to parse through that because multiples are still very low. But you look at gross margins, they're over 80%. Micron, SK Hynix. Can that persist into 2028, 2029? We think probably not. It's one reason, too, why we're seeing operating income across the broader S&P. Margins are expanding. But if we start to see gross margins in memory in 2028, 2029 just normalize, from 80 to 70 or 60, we're going to start to probably see margin contraction, or at least the productivity side of the rest of the market landscape is going to need to accelerate.
And you mentioned Apple wanting to get in on some of these Chinese producers. Also, those memory chips are a lot cheaper. Do you think at some point what brings potentially these numbers in is because there's just demand destruction because they're just too expensive for some consumer products?
I think there's less evidence of that, Anne-Marie, and I think there's just more evidence that there may be right now today with the dearth of memory, double ordering, triple ordering happening. What if we're just ordering to meet demand, and that's something that we start to see in 6 to 12 to 18 months? Could that, sort of spark a deceleration in a component of the AI trade? It actually could bring great cheer to many elements of the AI revolution beyond memory, beyond the chip space. And so we're very excited about that because we could see margins actually expanding within the software segment that's leveraging compute power. And that's very exciting for some of these companies.
So we're talking about the stock side of things, and we keep asking people how contingent is that on the yield space, and this idea that yields, at least if they are going up, are doing so in a controlled manner. And this week we have auctions as well as some of the retail sales, CPI and PPI. How important is it for you that the $25 billion of 30-year notes being sold on Thursday goes well, that we don't see evidence of this crowding out from some of the hyperscaler issuance?
It's an interesting question. I think we have to realize that the vast majority of new Treasury issuance is actually occurring in the front end of the curve, not the long end of the curve. Look at the front end of the curve year to date. It's up almost 75 basis points. The long end of the curve is up about half of that, the long bond. and the 10-year is somewhere in the middle. So I would be more concerned if I were the Treasury, that long-end rates, if they're going to be leveraging and sort of leaning into Treasury bill issuance, into two-year issuance, that long-end rates continue to go higher. Now, obviously, that's going to be predicated on inflation data, which we see this week, CPI and PPI, how the Fed sort of postures the question around AI. It's a near-term inflationary pressure, but it's a medium to long-term potential disinflationary pressure. That's going to impact the short end of the curve. And that's going to be really important to the Treasury, perhaps more important than the long bond.
It feels like it's been a long summer, right? I mean, it feels like it's just been incredibly tumultuous. It feels like it's been a long year. It feels like we're constantly dealing with new narratives and huge whipsaws in markets. And I looked at the VIX and I was thinking, it's going to show this incredible whipsaw action. And it has fallen to the lowest level going back to early January. How do you make sense of that?
Well, what's interesting, Lisa, is that you're absolutely right. But if you look at the individual security level volatility, the drawdown year to date, the most significant drawdown for the S&P 500 has been 9%. But the average stock within the S&P 500 has had a 23% drawdown. If you look at the NASDAQ, it's been like a 42% drawdown, 42% average stock drawdown on the index, only having been drawn down within this year by about 13 percentage points. So there's a lot of volatility under the surface that sort of belies the VIX.
Kennon of Clear Harbor Asset Management, thank you so much for being with us. Always great to kick off the week with you. I mean, to me, that was sort of shocking, but it kind of speaks to what a lot of people are talking about, even with the bond space. The 10-year, we're wringing our hands, and yet we've seen this range of, say, 50, 60 basis point, despite everything that we keep hearing with the Federal Reserve.
Range bound, but as Aaron said, like all these stories, everything is under the hood. Julian Emmanuel this weekend, his first line of his note, low VIX is masking huge volatility underneath the index hood.
Which is why a lot of people are talking about single-name stock picking making its return. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yie-Hsin on Yie-Hsin.
Good morning, Lisa. Israel is rejecting a U.S.-backed peace proposal with Hamas. The U.S. plan calls for Hamas to lay down arms in tandem with the gradual withdrawal of Israeli troops. Israel's Prime Minister Benjamin Netanyahu saying the IDF will not carry out any withdrawal until Hamas is genuinely disarmed. The Pentagon is pressing major defense firms to speed up production of key weapons and missile defense systems. Concerns are rising about U.S. weapons stockpiles following the war in Iran. President Donald Trump denies the U.S. is running low on munitions. And J.P. Morgan is raising its S&P year-end target to 8,000 from 7,800. Strategists saying a strong earnings season and faster than expected AI monetization for hyperscalers is boosting its profit estimates. Ed Yardeni is still the most bullish on the street with a year-end target of 8,250. That's your Bloomberg Brief, Lisa.
Thank you so much, Yie-Hsin. And we're almost there. We're almost to 7,800 to give you a sense of how people are catching up to where the market currently is. Up next, waiting for Iran to break.
I want to give them every last chance before decapitation.
I think it'd be very smart to make a deal. We'll see what happens. I'd rather make a deal because I don't want to kill people.
I think it's going to end pretty soon. I don't think they can go much longer.
Colonel Wayne Sanders of Bloomberg Intelligence joins next. You're watching Bloomberg Surveillance. To build on what we saw last week, which was the biggest rally going back to April. This morning, we're seeing a bit of a bounce on the S&P 500 thanks to earnings. That has been coming in strong consistently, and it's what every single strategist points to when they talk about upgrades. We're seeing about a 0.1% gain in the S&P futures. NASDAQ futures up 0.3%. That is where the outperformance has been for the first 2 weeks in a while, where we're seeing the market cap weight outperform over the equal weight. The Russell 2000 lower by 0.3%. Despite some of the gains that we're seeing in the bond space, 2s, 10s, and 30s really taking its cues from what we saw last week. A huge decline when it comes to rates, at least in the front end of the yield curve, people repricing the possibility of some sort of rate hike in September. After a weak non-farm payrolls report, do we get a shift with the all-important CPI print on Wednesday? We're seeing just a marginal increase at the front end of the yield curve, up a basis points to 421. But to me, ultimately, Annmarie, and we've been talking about this extensively, how much focus has shifted to the inflation read over non-farm payrolls? Yes, we saw the first contraction in headline jobs going back to February, but the unemployment rate fell to 4.1%. And there are a lot of asterisks under the surface about hiring on a local level, as well as leisure jobs that might have just been a time frame issue with the World Cup.
A lot of asterisks, but a lot of people have taken this as this was a dovish signal. And everyone was already looking towards the inflation print, because what we learned from the Financial Times last week, that for Kevin Warsh, that is going to be really the North Star. So as long as inflation continues to fall and we see CPI fall, then everyone's thinking, okay, we can get through September. It's going to be a hold.
And a lot of this is going to really have to depend on what's going on in the oil space, because even though the headline index in the stock market has not been volatile, oil prices whipsaw from place to place every single day. Today, just ticking up, inflecting higher by about 1% on Brent to $84.40. WTI up about 1% after last week seeing a pretty significant decline. Oil prices, WTI down 7.7% last week. Brent down about 5%. 2 consecutive weeks of declines now, seeing just a bit of a reflection of the increased friction in the region. Under surveillance this morning, waiting for Iran to break.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal.
At some point, they're going to say, we just can't take it anymore. I want to give them every last chance before decapitation.
I think it'd be very smart to make a deal. We'll see what happens. I'd rather make a deal because I don't want to kill people.
I think it's going to end pretty soon. I don't think they can go much longer.
Here's the latest. President Donald Trump shifting from threats of escalation to, quote, low-keying it with Iran. In an interview with Axios, Trump saying he is ready to let economic pressure build on Tehran. Bloomberg's Abir Abu Omar joins us now from Dubai. Abir, what's your latest take on what exactly the shift in thinking is from President Trump?
Good morning, Lisa. Well, a lot of the analysts that we've been speaking to see this shift as giving credence to the fact that we had so many reports over the past week or so suggesting that the U.S. is running low on ammunition. Now, President Trump, other U.S. officials, as you know, have come up and said that that is not true. They've refuted that argument multiple times. But then when President Trump shifts from threatening to threatening the biggest attack since World War II to saying that he doesn't want to come back to the negotiating table with Iran, and plenty of those harsh remarks, to then saying that he is low-keying it with Iran, that he wants to wait for Iran to succumb to the economic pressure. And while it is true that Iran is facing massive inflation numbers, about 80% year on year, the fact that President Trump suggests that he wants Iran to succumb to the economic pressure is seen by a lot of analysts as an unrealistic argument, because it is very cheap for Iran, and we've made this kind of thesis multiple times. It's very cheap for Iran to produce those drones that have been threatening vessels and tankers in the Strait of Hormuz. And it only takes the threat, right, the idea of a threat for those vessels and tankers that have been stuck in the Strait of Hormuz over the past 5 months to start being a little bit more cautious, trying to make their way through the waterway. And obviously, they have been cautious, trying to make their way through the waterway in the midst of all this uncertainty about whether they're going to actually get hit or not. We've reported again that the deal between Oman and Iran that Iran had said Washington is not involved in is in the final stages. We don't have a formal agreement yet. We don't have a formal draft of what exactly that mechanism will be for ships that are trying to make their way across the waterway. For now, you're seeing traders a little bit cautious on Brent crude prices. We're seeing them at around 83 when I woke up this morning in Dubai, and then $84 on the barrel. So a little bit of caution there with those threats in the Strait of Hormuz, but also in the Red Sea, the Yemen-based Houthis that have been threatening the movement there as well. You're seeing that elevate prices a little bit on energy and crude products.
Abir Abu Omar, thank you so much for taking the time. Colonel Wayne Sanders of Bloomberg Intelligence joins us now for more. Colonel Sanders, I would love your take on why the new approach from President Trump away from some of the more dramatic rhetoric and to a sort of we can wait and see mode.
Yeah, I think, we've talked about it on here before as well. When you're dealing with a government like Iran, right, if we were dealing with any other country in the world, this would already be over. But when you're dealing with a country like Iran, this theocratic government that's run, we've joked also about calling it the three-headed hydra. You have to deal with the IRGC, you have to deal with the president, and you have to deal with the Supreme National Security Council. And all three of those have to be in alignment to be able to do this. And I think that President Trump is really looking at it and saying, even if we tried to go the obliteration route, unless you were going to just turn Iran into a parking lot, for better terms, you're not going to be able to achieve the center of gravity that you want. You're not going to be able to achieve that mass effect because Iran has proven that they're willing to kill their own people. So from that perspective, I think they're trying to lift and shift. Abir is right, though. I mean, when you're looking at the cheapness in terms of building the Shahed drones does become an issue. And I think that's what's driving what we talked about a second ago as well about the start of this new production, the 21-day deadline that's being pushed from the Pentagon to the industry as well.
We've also learned that a former commander-in-chief of the IRGC is now going to be the new leader of the Supreme National Security Council. Do you think we're going to expect a more aggressive posture? Because at the same time, Washington says there's a real debate going on in Tehran about those who are concerned about the domestic issues like the economy and those who still want to maintain an aggressive posture with the United States.
Yeah, I think this is definitely a very strategic move by Iran to put somebody who is a stronger hardliner into that position, because I think when you were trying to look at the balance between the three parts of the Hydra in that normally you would look at that, the Security Council side of the House is actually one of the ones that's normally more balanced on the political side. And so now putting an IRGC former commander in there is pretty much showing that there's now two sides of it that's going to be leaning more towards the aggressive military posture, and the U.S. should be prepared for that in case.
What do you make of what's going on at the Pentagon, urging defense firms to accelerate weapons production? Does that just signal how low we are on inventories?
I think it's a little bit of an indicator of that. Obviously, it deals mainly with specific types of weapons, right? There is a ton of weapon systems across the military arsenal that the U.S. still has tons of stockpiles. So to say that we are not, prepared for additional fighting, that is not true. Now, if there are certain types of capabilities, especially when you look at PAC-3 interceptors, we know that there's definitely been a depletion there based off of how many we've used, as well as THAAD interceptors, the Terminal High Altitude Air Defense System as well. You look at those, a lot of munitions production facilities are now ramping up on that as part of these larger multi-year framework agreements. Lockheed has been asked to triple their PAC-3 interceptors, quadruple their THAAD interceptors. There's also a precision strike munition, which is a long-range munition. They've been asked to quadruple as well. RTX does a lot with SM-3s, SM-6s to at least double, if not triple, their capacity for those interceptors as well. So all of those pieces are taking place. This 21-day thing that you're seeing right now that's coming from Deputy Feinberg, one of the key things here is the fact that you have to have exquisite munitions, but you also have to have low-cost containerized munitions that can be something that's a little easier there, and then even some more investment into directed energy, the high-energy lasers and high-power microwaves. All of those things are going to be able to help create some type of offset compared to what Iran does with the Shahed drones.
Colonel Wayne Sanders of Bloomberg Intelligence, thank you so much for taking the time. I am struck, Annmarie, about how much oil prices have come down and how consecutively they've gone down week after week, even in light of the lack of a resolution. And it just highlights that people expect the peak of this conflict to already be behind us.
Wall Street has moved past it, even though clearly in the region it is still happening. The Strait is effectively closed. Then yesterday you have the Houthis going after a Saudi oil refinery. You still have issues in terms of what's going on in Russia, Ukraine, the Black Sea, the Caspian Sea. Yet at the moment, Wall Street is moving towards it. But again, how many strategists have come on this program, the Jeff Currys, and saying, do not look at where Brent and WTI are trading. You need to look at where product is. And that's where potentially you see a lot more volatility and a lot more pressure.
Enter CPI on Wednesday and then PPI on Thursday. The expectation is about a 0.1% bounce back after a negative 0.4% decline in the prior read. If we get that, does that give a bit of a sense that maybe we're getting the pickup inflation, but low enough not to put the Fed on the hot seat. A real question here as we also get a slew of bond auctions, some earnings, CoreWeave coming into the end stretch of this particular earnings season. Coming up, we're going to be talking about the tech sector. Sarah Kunst of Cleo Capital as hardware demand pushes TSMC sales higher. Plus, Yie-Hsin back with your morning movers. Supermicro rising ahead of its earnings this week. Also, CoreWeave, a real question there with its debt profile. This is Bloomberg Surveillance. Good morning. Coming into another Monday with a lot of question marks with all of the data points coming. CPI really reigning supreme on Wednesday and then PPI on Thursday. It seems like this Federal Reserve is seeing this as the primary potential indicator. Right now, stocks trying to inflect higher after the biggest weekly gain going back to April as people take a look at earnings and say all of those geopolitical worries, all of the concern about leverage, it's behind us. S&P futures building on that up 0.1%. Interesting to see how last week's intervention in the Japanese yen trying to support it prop up the valuation is not working. It continues to fade this morning with the dollar strengthening versus the yen, even with Bank of Japan meeting minutes coming out saying that they'll be willing to hike rates potentially as soon as September, indicating that they were potentially going to be in action later this year, earlier than expected. Annmarie, it's just notable to see it not really working with this move continuing to claw back to 158.80.
Right, and a lot of people are looking at the euro yen because the fact is that when the U.S. stepped in, it was to sell euros to try to prop up the yen. And right now, what you have this morning is actually the yen weakening against the face of a rising euro. And you look over these minutes, and now you have a lot of economists coming out like Bloomberg Economics pushing forward this idea that we're going to have to see rate hikes a lot earlier when it comes to the BOJ.
Unclear exactly what that will do for the currency, considering the potential ramifications for growth. You are seeing yields inflect higher, just a touch on the front end of the yield curve in the U.S., and oil prices also up just about 1%. 3 hours away from the cash open, here are your morning movers with Yie-Hsin.
Hi, Lisa. We start with the AI server company Supermicro. Shares are up 3.5% ahead of earnings tomorrow, and the setup follows what we've been hearing across tech earnings, that the hyperscalers are committing more to AI and data centers, and Supermicro should be on the receiving end of some of that spending. The company already gave us an early look at what demand will look like this quarter, saying it booked more than $60 billion in new orders, and that should help it beat on the top and bottom lines, according to Bloomberg Intelligence. Another company reporting tomorrow is the Neo Cloud CoreWeave. Shares up about 1% in the pre-market. The expectation is its revenue should more than double from a year ago, but its tech and infrastructure spending will more than quadruple. And we know CoreWeave has relied heavily on debt to fund that expansion. And now that investors have become a little bit more cautious about funding some of those AI projects, it will put more pressure on CoreWeave to show that it is generating meaningful returns to justify all that spending. And we end on the space trade with SpaceX shares up 2.5%, extending a more than 20% gain over the past 5 sessions as that lockup expiration came and went with no meaningful pressure on the stock. So that's helping to remove a big overhang. But otherwise, that's also helping provide a lift for Rocket Lab, which is up 3.5%. It reports earnings after the bell today. Lisa.
Thank you so much, Yie-Hsin. On our radar this morning, President Donald Trump signaling a strategy shift in the war with Iran, saying the U.S. is, quote, low-keying its approach to the conflict, letting economic pressure build rather than launching fresh military strikes. Meanwhile, the Bank of Japan weighing its options as inflationary pressures build, as we were just talking about. Minutes from the central banker's July meeting, where it held rates steady, showing one policymaker advocating for a faster pace of rate hikes going forward. You're not seeing the read-through, at least not in the yen. Meanwhile, China going all in on its push to challenge the U.S. in the AI race, tapping its $28 trillion in capital markets to close the gap. Fast-tracking IPOs for strategic companies like memory chip maker CXMT, which saw its shares surge by 500%.
And when you look at this story, it looks like because of what China's doing in terms of fast-tracking IPOs, letting these companies tap the debt markets, what they're doing is basically propping up companies like CXMT. And it comes at a time when we're really talking about this company because of what U.S. national champion Apple is looking to do. Wall Street Journal over the weekend saying they're starting to test these products in iPhones and other Apple devices. This would just be sold in China. But still, it's Apple trying to shore up some of these chips that they're going to need. And when you're looking at China, they're potentially going to be using a Chinese company.
Yeah, Diplomat-in-Chief Tim Cook talking extensively with Washington, D.C. about allowing them to use CXMT chips in Chinese aimed products. A real question, though, about what this means for some of the competition in places like South Korea. I mean, this really goes to the question of if you have margins that are too fat, you're going to invite competition, and that's what you're starting to see right now.
You're going to see the competition now, especially with China on the rise when it comes to things like CXMT, but also the national security issues. If they allowed Apple to do this in China, what other companies are going to be lining up and saying we could potentially get cheaper chip components? We want to do the same thing.
Either way, chips still very much in vogue. And sticking with that sector, Taiwan Semi reporting a 45% surge in monthly sales, signaling sustained demand for its AI hardware. Matt Bloxham of Bloomberg Intelligence joins us now. Matt, it strikes me that you see some of these numbers. They seem surreal, but they're actually sometimes lower than expectations. What did you make of this earnings report and the CapEx that came in pretty much in line?
Yeah, so see, these monthly sales updates are pretty light on detail. You just kind of get the revenue number and the sequential and year-on-year growth. As you say, 45% year-on-year growth. That was a slowdown on the June print, which was about 68%, but still tracking well ahead of the year-to-date average, which is about 36% growth. And yeah, let's not forget that a few weeks back, they upgraded full-year guidance on a dollar basis to more than 40% growth, and that was up from 30% previously. So, I think this is consistent with the positive narrative we've seen coming out of the company. Huge demand from the likes of NVIDIA and Apple for their contract manufacturing, and there's no near-term end in sight for that momentum. As you mentioned, they've increased CapEx guidance for this year. That's another strong sign that near-term demand is strong. Some of that investment is going into Taiwan, but obviously some of it is going into the US, where they've massively expanded their domestic manufacturing capability to meet demand from the likes of Apple and NVIDIA, and to kind of make sure that they're compliant with this Made in America push from the administration.
Matt Bloxham of Bloomberg Intelligence, thank you so much for the update. We'll be watching those shares throughout the day, especially ahead of CoreWeave and Supermicro. Sarah Kunst of Cleo Capital writing, I've said for years, TSM is a linchpin of AI. It is essentially irreplaceable in chip production for the next 3 to 5 years, with no real competitors on the horizon. Sarah joins us now for more. Sarah, thank you so much for being with us. I want to take a step back, because what we've seen over the past week is a real sense that tech is safe again. We've had leverage kind of pushed out of the system. We've had earnings, particularly from the hyperscalers, that seem to confirm the story that they're able to monetize more quickly than people previously expected. Do you think that it makes sense to lean into the bull case with TSMC just one pillar of the overall positive?
I think it makes sense on a case-by-case basis. So I think TSM is in a pretty safe place as long as you think that the sort of overall demand for chips is going to stay pretty much flat or even a little bit up over the next few years. I think Alphabet is in a potentially really interesting situation when you look at the stock price versus the revenue. But I think that there are still a lot of other names in the space, like the SpaceX's, that are really, really overpriced and that make me nervous. CoreWeave's another one of those.
There's an issue right now. People are trying to imagine what the world looks like in an AI universe. And there's this question of hyperscalers versus the adopters, as Mike Wilson is talking about, that he's looking for. How are you expecting us to understand consumer products that might have AI? And I'm thinking about Google and their phone that will be coming out later this week, or potentially even Apple that's going to be talking about their foldable phone, but maybe with less AI coming out in September.
Everybody's making foldable phones and glasses. It is unclear if anyone wants them. But I mean, I think, one, it's a great reminder, hey, Google makes phones. And also Google powers the Android ecosystem of 3 billion devices, right? Google touches across a lot of their properties well over 4 billion people every month. And so that's one of the reasons why I do think that they will be ultimately the AI winner. They have a baked in user base across devices, across consumer products and enterprise that just dwarfs any of the competitors.
Can they be the winner when it comes to mobile phones because of where they are in the AI race?
I mean, are we all going to have Pixels? No. But do a huge swath of people, particularly globally, have Androids? Yes. Do we know that very often Apple has ambitions on its own and then sort of goes back to Google and says, actually, can I just borrow your OS? Can I borrow your search bar? I'll pay you for it, right? So we know that it is likely that Google at the end of the day will power, particularly in mobile, the vast majority of on-device AI. And I think that is a pretty logical step in when you pull back and look at their dominance with the Android OS.
When it comes to mobile phones, Lisa and I were just talking about how there's this journal report over the weekend how Apple is testing CXMT memory chips to put in their product lines. Are we opening up a can of worms here in the United States?
In terms of Chinese chips, I mean, I think that we are going to sort of surface what has been happening underneath, which is we know that China gets their hands on a lot of NVIDIA chips that everyone swears they don't have. And I think a little bit of vice versa, which hasn't happened a ton in the last decade, is not shocking. I also think that it opens up the competition more to say, hey, maybe we have to drive these prices down. The reason that the Apples of the world are curious about using these other chips is largely because of price, and then obviously the political climate in China. And so if these chip companies have to be a bit more competitive on price, I think that is not necessarily a bad thing for the market, even though it might be a bad thing for their stock.
I'm glad that you mentioned that, Sarah, because it seems like increasingly the AI story is a financial market story and a capital intensivity story. The idea that you have to raise potentially $3-4 trillion in the next couple of years in order to build all of the hopes and dreams of these companies. How important is it going to be that margins compress in some of these places, whether it's memory chips or other potential components that go into this universe at a time where investors are that much more focused on rapid monetization before they hand out more cash?
I think it's going to be really important. I think that we're going to see pressure that, hey, look, NVIDIA, it's great that your margins are so big, but one, that means there's a lot more sort of competition happening. We know that, the Googles of the world, a lot of companies are working on their own chip design, but then on the other side, there's only so much that people can bear, right? And when we look at Apple having to raise their prices and because they can't get their hands on chips and everything else, a lot of these price increases are starting relatively small, but they eventually snowball against a consumer that is really feeling the pain. I think we're going to see more of that in the University of Michigan report this week. So I think that we are at this point where all the VC dollars in the world don't make a difference if at the end consumer, the end small business can't afford to buy what you're selling because they just don't have the cash.
It seems like Apple has been rewarded for a number of months for not having as much capital intensivity as some of the other AI-related companies. Do you think that can last? We're just seeing a report that a Jefferies analyst who's really tracked closely Edison Lee by the Wall Street community downgraded their expectation for Apple. You're seeing shares down some 1.2% in response. I'm just wondering if that makes sense to you based on its recent rise and, frankly, some of those questions that you were just talking about with consumer health.
So I think you also have to remember there's another big narrative happening inside Cupertino, which is they're getting a new CEO and they have a long beloved CEO who's done a really good job. And the new guy, while not new internally, is pretty new to the market. And so I think some of this is a little bit of a question mark, a little bit of a let's see what he's like. Do we like this new boss? And so I would put some of that downgrade, I would put some of those concerns in the bucket of would this be happening if Tim Cook were still in charge doing the same thing? And on the other side, I think there's a problem that Apple has, which is a good problem to have for consumers, which is their products are so good and they're relatively reliable that you're not constantly buying more. And so where do they get that extra money if your phones aren't getting stolen or you can get them back, right? And if your computer isn't breaking and you don't really need more memory. And so I think that's part of this problem for them, even though it points to the fact that their products are really, really good.
Well, hopefully our memory won't necessarily slow down in advance of another upgrade cycle. Sarah Kunst of Cleo Capital, thank you so much for taking the time. Right now, let's get you an update on stories elsewhere this morning. Here's a Bloomberg Brief with Yie-Hsin.
Hi, Lisa. ADNOC Gas is investing more than $8 billion to expand production as the UAE ramps up energy output after leaving OPEC. The Wall Street Journal reporting that the Abu Dhabi-based company will use the money to grow its gas processing and export capacity. Berkshire Hathaway spent about $4.5 billion to buy back its own shares in the second quarter. It also purchased nearly $20 billion of equities, a sign that CEO Greg Abel is putting more of the firm's cash pile to work. And the U.S. Senate passing a short-term spending bill to avert a government shutdown. It will keep the government funded through December 11th. The bill now heads to the House, where lawmakers are expected to take it up later this month. That's your Bloomberg Brief, Lisa.
Thank you so much, Yie-Hsin. Up next, taming price pressures.
We saw the last inflation number for CPI was negative and the core was zero, so that the inflation numbers that we're seeing are really coming down rapidly.
Will that be enough for the Federal Reserve? Leslie Falconio of UBS joins us next. This is Bloomberg Good Morning. Building on the biggest week of gains going back to April as we see this disinflationary tilt take hold of markets. This expectation last week, we also saw oil prices come down. We saw a disappointing payrolls report, at least in the headline number. You saw the probability of the Federal Reserve hiking rates in September go from about 57% to near 40% this morning. We're building on those gains this morning in the equity space led by tech. The earnings very much front and focus, up 0.3% on NASDAQ futures. The Russell 2000 underperforming, down about the same amount that the NASDAQ is up. And what we saw last week was a change from what we've seen earlier in the summer, which is we saw the market weight underperform and the market cap weight the equal weight continue to underperform and the market cap weighted outperform. Last week, we saw the S&P market cap 3.6% gain versus the equal weight of 2.4%. A lot of this has to do with what's going on in the bond space because of this disinflationary tilt and this question around exactly how the Fed is going to respond, even with pressures in the long end of the yield curve. We're seeing this morning two-year yields inflect higher by 2 basis points, 4.22% in the face of higher oil prices. Again, it comes down to the story of how long that's going to really feed into some of the inflation prints. Under surveillance this morning, taming price pressures.
People absolutely are feeling legitimate problems when they go to the grocery store. We saw the last inflation number for CPI was negative and the core was zero. The last inflation number for PCE was negative, so that the inflation numbers that we're seeing are really coming down rapidly.
Here's the latest. The White House downplaying cost concerns as investors went to Wednesday's CPI report. Bloomberg economists expecting inflation to slightly cool, although 0.1% is the expectation for the headline CPI increase. Leslie Falconio of UBS writing the near-term uncertainty regarding the Fed's reaction function will likely result in investors initially selling the rally in Treasury until the inflation path is clearer over the next few months. Leslie joins us now for more. Leslie, great to see you. Thank you for being with us. The irony in all of the confusion around the Fed is that a lot of people on Wall Street said they had a legitimate reason to stay on hold because inflation was on the margins when you look at core coming in. What's your expectation for how that relationship between the Fed and CPI plays out this week?
You know, I think it's important, and one of the things, as we know, is that the last CPI print came in well below expectation. You know, Chair Warsh, made a point of saying one number does not make a trend, which it doesn't. So we do think that this week's inflation number is going to be very important, more important than what we saw on Friday's payroll, although obviously that wage component, staying stagnant or not rising is one of the reasons why we don't believe the Fed, will hike in September. But I think that the upcoming wage numbers are really going to be very important to what the market's pricing in and in terms of some of the rhetoric we have at the end of the month from Jackson Hole.
That said, right now we are still seeing the expectation that inflation is going to remain above the 2% target from the Fed, even though we have Fed officials talking about how impatient they've become. So at what point is it enough progress to really take the pressure off the U.S. central bankers?
I think that's a lot of the questions that the chair was asked during the Q&A, and I think that's really important in terms of what the market's expecting in terms of some sort of communication. So there's a difference between, as we know, having the inflation above target and having, demand side inflation. So what is enough, I think, is really what the market is trying to really acknowledge and get that information from the chair. And that's why I think when we look at, say, the September Fed meeting, we can't necessarily assume, we don't think that they hike, but say hypothetically if they don't and they just stay stagnant, that we're not going to see that twist that we saw in the previous Fed meeting where the long end went up and that short end yield went down and correlations broke. And I think that reaction function is going to be very important.
When Lisa was just mentioning what's going on in oil prices, they continue to remain elevated. We're just in this status quo in the Middle East. Can the Fed just continue to look through this even if it goes to the end of the year?
This Fed is not just demand side. We know it's supply side driven. I think that the thing about the Middle East crisis, there's no question, and it's not just about the magnitude, but the duration has grossly been underestimated. But I think because we're not really seeing the cap that we saw in those oil prices, the market is more accepting. It also realizes as well that the floor is going to be higher also. I mean, we know from the last payroll report, we had some headwinds in terms of leisure. A lot of, economists are pointing to the rise in gasoline prices as a reason why we saw this decline. But I don't think that's really a driver right now in terms of this inflation side. The chair won't necessarily look through it, but I do think the demand side is going to be much more important.
So what are you expecting from Jackson Hole, given he said this is going to be a blank piece of paper? Do you expect him to explain his reactionary functions and try to gain some of that credibility that some individuals think he lost in the press conference?
I'm trying to keep my expectations low. So I think that there will be some, talk around that. Obviously, he has faced a tremendous amount of criticism. I do think there will be a bit of clarity, but I wouldn't expect him to shift his entire communication style. I don't think that's what he's going to do. I wouldn't expect him to give more forward guidance. I think he's going to stay pat with his own style, but he might, learn a bit of lessons as new chairs have, communication issues, every time they come into the seat. His just has been magnified.
How concerned do you think right now central bankers and frankly our own Treasury Secretary is about the 10-year and the 30-year Treasury yields in light of the huge volume of sales coming from hyperscalers that a lot of people think are directly competing with the U.S. Treasury in terms of longer-term debt, as well as, frankly, the Bank of Japan and what's going on there, given if they raise rates, it could potentially push some of the domestic buyers away from the U.S. market?
I think he's very focused on it. I mean, there's a lot of structural changes that we've seen, over the past decade, Japan being one of them, from disinflation to inflation. They've recently had a very large bear steepener, which obviously rolls over to the U.S. market. As you mentioned, we've had a lot of hyperscaler issuance in that back end, which is, part of the reasons why Treasury yields are moving higher, not the main reason. I think it's a big part, and I think that's one of the reasons why you saw the change in language, in the recent refunding announcement. I know there are a lot of people on the street that, look at that as an open door to potentially cutting long end supply in the future. We are not there yet. We still think the deficit is an issue, but the door is open for that. And I think if that has to occur, if in fact we bear steepen, say above that 5% threshold sustainably, I wouldn't be surprised if that's some of the actions that they take.
Leslie Falconio of UBS, thank you so much. That last point there is something that we've heard from Gennady Goldberg over at TD Securities and others, that sort of the ambiguity around the Treasury refunding announcement really had to do with just this idea that potentially that $25 billion of 30-year notes sold on Thursday could go down to what, 15, 20 billion? It could be continue to be reduced in light of what we're seeing in market.
It's so interesting, too, because this was a key concern Scott Bessent had before he was Treasury Secretary on then Janet Yellen, saying that they're issuing too much on the short end. But this administration is doing the exact same thing.
At a certain point, reality takes over some of the ideological concerns, especially as interest expense goes above the Defense Department budget in the United States and is expected to continue to climb. Right now in markets, more broadly, you are seeing a continuation of the good vibes, at least when it comes to equities and tech names. Maybe a little bit of a sell-off, though, in the front end of the yield curve as people take back some of the disinflationary deep breath that they took last week. Coming up next, Jim Caron of Morgan Stanley, Henrietta Treyz of Veda Partners, Emily Bannister of Wellington Management, and Kathy Bostjancic of Nationwide. This is Bloomberg Surveillance. Good morning.
you do have an economy that is moderated.
The labor market is softer than it appears earlier in the year.
Under the surface, there really is some strain, and I think it's important for the Fed to be listening to it, especially for the chair.
You don't hike to get credibility. You sort of don't shoot yourself in the foot to make sure your gun works.
This report will quickly become yesterday's news, and the more focus will turn to the inflation side.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inflecting higher after the biggest weekly rally since April. S&P earnings heading into their final stretch after delivering the biggest boost to both CapEx and earnings growth in years. And questions about the Fed's policy path remain, with a key inflation print on deck for Wednesday. CPI coming up. Annmarie, that's the event of the week, yes. But the week does start today.
The week does start today, but it is going to be the anchor for the week, because we already felt this way going into this week, when we know that Kevin Warsh, and according to the Financial Times, people familiar with him, wants to look at that inflation data, and if potentially it's hot, he would be more inclined to potentially having that real robust discussion about raising interest rates maybe before the end of the year. But now, after we had the dovish, what people are looking at, the dovish employment report, it really is going to be, once again, all about CPI. And depending on whether or not the Fed potentially has this reactionary function in September to hike interest rates.
Yeah, the FT, the sources familiar with the matter, talking about how this is a Fed chair who would be willing to hike rates should inflationary pressures remain consistent and resilient. What that means exactly unclear. Right now, stock markets are not waiting around to find out. We've seen an incredible rip in tech stocks in particular. A lot of the momentum that got eaten away because of situational awareness has now come roaring back on the heels of earnings. We get a slew of earnings, CoreWeave, Supermicro coming out later this week. But so far, the fastest pace of earnings going back to 2021 was some 30% growth. And it really goes to the question of, is this as good as it gets? And is that enough for people to keep being bullish?
And to reignite that, we have TSMC today reporting a 40% rise in its monthly sales. Sustained demand. It continues for this year and for next year, which is why you see the likes of JP Morgan having to elevate their year-end price target, because we're already at the levels individuals have already set at the start of the year, which is fascinating, given the fact that if I said to you at the start of the year, everyone's going to be in the middle of a conflict in the Middle East with oil prices rising, everyone's going to be saying, actually, we're going to boost our year-end target, you'd probably think I'm crazy. But that's what it is right now, because everyone is on this AI trade.
In the meantime, one place that has not been on the AI trade has been Apple, and it's been benefited as a result of it because of the CapEx that they have not had to spend on building out their AI story. Today, those shares are down 1.2% after a Jefferies analyst came out and downgraded their price target. This analyst, Edison Lee, is saying that supply chain checks done by Jefferies suggest that the all-glass iPhone has been canceled due to low yield. This was a phone that was supposed to come out in 2027. And the key question for so many different analysts is, yes, we've seen a lot of resilience. Yes, we've seen an upgrade cycle. But how long can that continue at a time where people only need so many devices?
And when it comes to Apple, this is what gets people lining up outside the doors. When you have something that's so new and so exciting, and if you have this Jefferies analyst saying that basically they're not going to have this all-glass iPhone by this time, then potentially that's going to be a lot harder for Apple to try to get to some of these price levels when they just don't have that excitement.
Well, right now, markets have a little bit of excitement after last week's gains. Right now, we've seen S&P futures up by about 0.1%. You see the outperformance really coming from the NASDAQ, with futures up 0.2%, though clawing back some of that on the heels of that Apple downgrade. And the Russell 2000 futures lower by about 0.3% after really sort of going nowhere in the face of all of the potential rate volatility and outperformance for so many weeks. In the rate space, 2s, 10s, and 30s ahead of some big bond auctions so far this week. We are seeing yields inflect higher at the front of the yield curve. Key question: how much is enough to take the Fed out of play for September when we get that Wednesday CPI print? It is expected overall to be a deceleration on core CPI year over year, but will that be enough? Two-year yields up 2 basis points to 4.22%. We've just been hovering around there for a number of weeks. weeks now. In the 30-year space, we're up just a basis point to 5.2%. And then in the crude space, a lot of people looking at sort of this low burn conflict as the new normal. Today, we're seeing oil prices up about 1.5% after last week's decline of about 8% on WTI and 5% on Brent. Just sort of a strange never land when it comes to this story. Coming up, Jim Caron of Morgan Stanley with stocks coming off their best week since April. Henrietta Treyz of Veda Partners as U.S.-Iran negotiations hit a lull, and Kathy Bostjancic of Nationwide as investors pare back rate hike expectations. We begin this hour, stocks steady ahead of a big week for inflation data. Jim Caron of Morgan Stanley writing reduced communication by the Fed could result in more volatility. These changes may have valuation implications despite healthy earnings and broader market participation. Jim joins us now for more. Jim, great to see you. Thank you so much for being with us. How important is Wednesday's data?
I think it's critical. The reason is that this will be the hurdle that probably makes the decision whether or not the Fed moves in September. I mean, clearly the jobs data has been weak, but if you get a hot CPI number that comes out, that's going to create some problems. I mean, for right now, I think you can reduce the odds of a Fed rate hike in September. But, you know, core CPI coming in somewhere around 2.5, 2.4% consensus, then I think September is not going to be a meeting that's really a live meeting where the Fed will make any action. But if it does come out hotter than that and it shows that there are some lingering effects and that it's necessary for the Fed to hike to contain that, then that can really, create some uncertainty in the markets.
How much does it really matter? I mean, at a certain point, we've seen stocks continue to gain despite some of the volatility, or at least the increase of longer-term yields. And we've seen overall market volatility actually not materially go up. So how much do Fed rate moves really matter for equity space, for potentially other risk assets?
Yeah, that's a great question, because what's driving higher equity prices right now is that we have higher nominal growth. Higher nominal growth drives higher earnings. And we're seeing that in the first quarter and second quarter. So let's look at nominal growth in the first quarter. Nominal growth in the first quarter of this year was around 6.1%. Normally, in the past several years, nominal growth had been somewhere around 4, right, in the lower nominal growth period. Now, second quarter GDP comes out, and nominal growth, if you look at the GDP deflator, is 7.9%. If you use core PCE as your inflation metric, then nominal growth is somewhere around 6.5%. It's very strong. No matter what metric you're looking at, it's very strong. So that drives earnings, that drives valuations, that drives equity prices higher. If the Fed hikes rates 25 basis points in the midst of all this, is that going to derail the higher nominal growth and higher earnings that equities are seeing? Not at all. The move with the Fed is more of a bond market event than it is an equity market event. And I think that's what we should be really focusing on.
But isn't this all because of AI? I mean, you have this John Author's piece this morning talking about this Columbia professor who argues that without AI and the data center build out, the U.S. would be in recession. Where are other parts of the economy growing?
Yeah, look, I mean, anytime there's an expansion, you can single out one sector that's doing way better than others. Is that abnormal? No. And by the way, the markets have broadened, right? So it's not just about AI in growth sectors and things like that. And yes, the AI build out does feed into a broader economy, but also remember that we have, tax policy, we've got deregulation that's going through. A lot of this stuff is broadening the economy and the remanufacturing, bringing back manufacturing and industry into the U.S. For every one manufacturing job you create 6 service sector jobs on the back of that. So the unemployment rate's relatively low. I know that some of that is based on demographics and a lower participation rate. But, there are many other metrics. Look at the NFIB, the small business surveys, where you're seeing a lot of strength in job hiring that's going on there. So, I really push back pretty hard on the argument that it's just about the data center build out. That's a very big part of that. But in every cycle, there's one dominant theme.
On top of that, Jim, how much is it real growth versus inflation just showing up in the deflator?
Yeah, that's exactly right. So when we look at nominal growth, you're including the inflation component of that, right? So it's not real growth. Real GDP is somewhere around 2% or somewhere in there, and that's right about at potential or above potential. But the thing is that we live in a nominal world. We get paid in nominal dollars. Equities get, nominal earnings, and that's going to still boost the prices higher, right? So it is true that it's not real growth, but from an index level and from the perspective of what do you think of the equity markets and can they move higher? Then yes, with higher nominal GDP. Clearly, if inflation's too high, then it starts to peel back valuations and it lowers multiples and things like that. We're not seeing that at this point, right? We're in a sweet spot for equities with higher nominal growth where valuations tend to stay, relatively high.
In this kind of environment, Jim, is a 60-40 dead?
So I've been highlighting this for a while. 60-40 is not my favorite allocation for many reasons. The dominant reason is the 40. It's not the 60. The 40% in fixed income. If you look at fixed income returns, if you just look at the U.S. Ag, it's zero for the past 5 years, right? It's actually slightly negative. If you look over the past 3 years, it's like barely above zero in terms of positive territory. So what's happening with bonds is that as yields have started to rise, and the correlations between bond returns and equity returns is very high, which means that your bonds are not hedging your equities as well as they used to. It also means that the contribution to return from fixed income is really, really low. So not only are you not getting a great hedge against your equities with fixed income, but you're also not getting a great return. That doesn't mean that you shouldn't invest in fixed income. You should, but you have to do it in a very tactical, active manner. Passive investing in fixed income is what's hurting you. But if you're active and you're very selective about your fixed income, that can be the greatest source of alpha, driving alpha in your portfolio. And that's something that we focus on. So 60-40 is not the magic ratio for me.
Jim, thank you so much for being with us. Jim Caron of Morgan Stanley. Have a wonderful rest of the week. Right now, let's get you an update on stories elsewhere this morning. Here's a Bloomberg Brief with Yie-Hsin. Yie-Hsin.
Hi, Lisa. Former President Joe Biden's cancer has spread to his bones and further. Biden's son Hunter telling the BBC his father's condition is, quote, very painful and debilitating. The president recently announced he is planning to release a memoir in November. Meanwhile, Apple is considering an overhaul to its smartwatch. Sources telling us here at Bloomberg, Apple is exploring watches without displays, as well as different screen types and sizes. The Apple Watch is the top-selling smartwatch, but it's facing more competition from companies such as Aura and Whoop. And Paramount is willing to guarantee it will release 30 movies a year in theaters if it acquires Warner Brothers Discovery. Sources telling us here at Bloomberg the agreement would require Paramount to release the films exclusively in theaters for at least 45 days and not make them available to stream for at least 90 days. That's your Bloomberg Brief, Lisa.
Thank you so much, Yie-Hsin. Up next, putting the squeeze on Iran.
I want to give them every last chance before decapitation.
I think it'd be very smart to make a deal. We'll see what happens. I'd rather make a deal because I don't want to kill people.
I think it's going to end pretty soon. I don't think they can go much longer.
Henrietta Treyz of Veda Partners joins next. This is Bloomberg Surveillance. Good morning. Seeing people lean into the bullish take this morning, just a touch after the biggest weekly gain going back to April, with JP Morgan analysts upgrading their price target from 7,800 for the year-end S&P 500 to 8,000, kind of catching up to where we are since we're already at that price target. Today, we were up as much as 0.1%. We've clawed back much of that in the pre-market trading. NASDAQ futures up now only 0.1% after having been up as much as 0.3%. The Russell 2000 still down about 0.33%. When you take a look at what's going on in the bond space, you can see maybe some people speculating that last week there was a bit of an overreaction to just how much the Fed got a reprieve from non-farm payrolls that came in negative for the first time since February. Today, we're building back just a touch of those rate hiking expectations with 2 basis points of an increase in the 2-year yield at 4.22%, just a basis point on the 30-year yield. Ahead of that auction on Thursday, $25 billion of 30-year notes being sold. Meanwhile, in the oil space, what is going on? I'm not sure. We're on a wait and see. It's getting bad. It's getting better. It's sort of in the same new normal, up now 1.4% on both Brent and WTI. Annmarie, it feels like every single day there's sort of a new headline, but no clarity.
Well, it feels like we're going 2 steps forwards at times, and then we take a huge, giant step back. So over the weekend, there's all this talk that we're going to get to a final agreement between Tehran and Muscat when it comes to reopening the Strait of Hormuz. And then Iran comes out and gives a list of conditions and demands to fully reopen the Strait of Hormuz that it wants from Washington, D.C., which a lot of them are dead on arrival. So that is why you have this continuous purgatory. And as we've been saying on the show, it's not just the Strait of Hormuz we need to really worry about now. It's the Houthis that over the weekend hit a refinery in Saudi Arabia, they claimed. It's the Caspian Sea, the Black Sea, some of these long-range missiles that are going deep into Russian territory. There's lots of dislocation when it comes to issues in the oil market right now.
Under surveillance this morning, putting the squeeze on Iran.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. At some point, they're going to say, we just can't take it anymore.
I want to give them every last chance before decapitation.
I think it'd be very smart to make a deal. We'll see what happens. I'd rather make a deal because I don't want to kill people.
I think it's going to end pretty soon. I don't think they can go much longer.
Here's the latest. President Donald Trump sitting back with Iran, saying in an interview with Axios, the U.S. is only semi-negotiating and watching financial strain build on the company. Bloomberg's Abir Abu-Omar joins us now from Dubai. Abir, what does it mean to slow walk this, and why the change in tone?
Good morning, Lisa. Well, we've seen this back and forth multiple times before. You guys were just talking about how many times we've really seen Iran and the United States go back on their words and what exactly they're demanding to end this war. Now, what we understand from a lot of the people that we've been speaking to on the ground is that possibly the reason behind this shift in tone and President Trump really hinting that he wants the economic strain to catch up to Iran could allude to these reports that have been coming out over the past couple of weeks or so about the low munition from the United States front. Now, President Trump, other officials in the United States did deny the fact that the United States is running low in ammunition. But then when President Trump says the strain on Iran will eventually catch up to it, he said that he was low-keying essentially those negotiations that Iran is adamant are not taking place with Washington. That really gets to show that maybe he doesn't really understand the resolve of Iran. We've reported multiple times over the past just how cheap it is for Iran to manufacture those drones that it uses to threaten ships in the Strait of Hormuz. Iran can continue to manufacture those possibly indefinitely. And the mere fact that it can just pose this threat on vessels and tankers that are making their way through the Strait of Hormuz, which is evident even now, that is enough to paralyze the movement there. Over the weekend, we also reported that a tanker flagged to ADNOC, that is the oil company in the UAE, was attacked, killing one person, injuring over a dozen people. But then Annmarie also mentioned that it's not just Iran that is attacking those ships. We also have the Houthis in Yemen, obviously backed by Iran, threatening movement in the Red Sea, hitting a facility, an Aramco facility in Yie-Hsin in Saudi Arabia over the weekend. That would be the second attack in a month on this facility. And again, this is the Houthi claim. Aramco did not confirm this. It did confirm that a fire was extinguished quite quickly and that there was no significant infrastructure damage. But then again, all these attacks, all these threatening, all the threats of this escalation just threaten the supply of energy that, again, in the Strait of Hormuz for the time being, we're seeing either paralyzed or hardly moving, and any ship that is deciding to make its way through the Strait of Hormuz is either deciding to do so with lights switched off or having to seek permission from the Iranian side. And then when it comes to the Strait of Hormuz itself, that deal that we spoke about multiple times between Oman and Iran is still not formalized. We're still awaiting the final draft and what exactly will be the details in that document.
Thank you so much, Abir Abu-Omar of Bloomberg in the Middle East. Henrietta, Treyz of Veda Partners writing Iranian control of the Strait remains an unacceptable cost of the war with Iran. At the same time, Henrietta, we heard from J.D. Vance over the weekend that oil is $80 a barrel, a lot less than it was at $110 at the peak. So how do you pair sort of the incompatibility of the idea of a toll on ships with some of the rhetoric of slow walking it or potentially allowing this to be the new normal?
Thanks for having me, Lisa. You know, it's really not about the revenue. I'm a tax policy analyst. That's what I've been doing on Ways and Means and Senate Finance for 20 years. The revenue is not the issue that I care about here. The issue is the fact that now every Western banking nation, insurer, tanker, shipper, international alliances will have to work with an international state sponsor of terror, as designated by OFAC laws, SWIFT laws. It's that coordination that we are now all forced to do with Iran and the IRGC as a result of the president's decision to start a war on February 28th. That's the unacceptable cost that doesn't have to do with revenue. We've seen the U.S. consumer be able to adapt to $4 and higher gasoline, even getting all the way up to an average of $4.56, which was the president's breaking point earlier this year when he signed the MOU and called the ceasefire. But the U.S. consumer has been able to stand this. The revenue is not the problem. It's the continued coordination and the emergence of Iran into the global landscape that is the core problem here, and the U.S. is nowhere near resolving.
Well, Henrietta, the United States and its partners are not going to allow their vessels to pay these tolls, are they?
Yeah, the paying of the toll is exactly the problem. And again, it doesn't matter if you charge $1 or $50. It's the fact that Iran and Oman are coordinating, that they are closer to a deal on organizing and orchestrating the Strait than the U.S. and Iran are in terms of control. And that is ultimately the spoil of war that Iran has gotten, which is, I think, in the long term, unacceptable to the United States. What I think of is the elections that are coming up. The president, in his first term, rightly said that democracy is a disadvantage as compared to communist China, or in this case, the IRGC. And that is exactly correct. If Iran has the ability to control even a fraction of what the cost is militarily to having control of the Strait or the cost of gasoline in the United States, they have an ability to influence our free and fair elections. That's a disadvantage for a democracy like the United States. And that's a real problem the president has to address here.
Henrietta, what do you make of the blockade, though? Because CENTCOM has redirected, as of this weekend, 55 commercial vessels, disabled 2 ships, and boarded 2 others.
Yeah, the blockade is incredible. You mentioned at the outset of this, which is always so valuable, that this is not just the Strait of Hormuz. It's Bab el-Mandab, the Red Sea, the Caspian Sea, the Black Sea, the expansion into the Russia-Ukraine war. I mean, there's a lot that we're asking the United States to police here. I think it's fascinating that the emergency supplemental that the Pentagon requested months ago now has not been passed by Congress. And it really is going to be fascinating to see when lawmakers get back in mid-September, which is 5 weeks from now. 5 weeks of continued blockade. At the outset of this, if memory serves, we were talking about spending $10 million to protect each ship that came through the Strait, whether that was our overhead helicopters, our naval preparations, any submarines that we had to help conduct flow through the Strait. I mean, that's really expensive, and it's in the supplemental, but they haven't passed it into law, as you know. So it's going to be even 5 weeks from now until they get that passed.
How related is the budget concerns around the war in Iran to this meeting that was reported by a Russian state-run media about Steve Witkoff and Jared Kushner heading over to Moscow?
They're 2 very disconnected dynamics. I am, like I said, really surprised that we haven't gotten an emergency supplemental. The senators could have passed something. It didn't need to necessarily be through a budget. I've been working with Democratic staff and Republican staff all summer long to see if there are votes for an emergency supplemental. And I believe that there are, but they haven't coordinated or liaised between the White House and Capitol Hill sufficiently to get any of that money to start to flow. And 6 months into a war, that's pretty remarkable. And like I said, it'll be another 7.5 months, the end of September, before we get anything. So there's a disconnect between what the White House is doing and any urgency on Capitol Hill for additional spending.
Henrietta Treyz of Veda Partners, thank you so much. And of course, there's a lack of urgency. They're all home for the summer.
Yeah, exactly. They're all home for the summer. When we say the end of the month, it's actually really September. It's August 31st when they come back. But this just kicks the can down the road because this is just a short gap funding measure until December.
Yeah, and at a time when people are saying that quite a bit more will be needed just for ammunition alone. Coming up next, Emily Bannister of Wellington Management. As investors become more selective in artificial intelligence-related debt, plus Yie-Hsin Anand with your morning movers, shares of Apple lower by about 1.2% this morning after a rare downgrade to underperform on Wall Street. people are bullish, but fading a little bit from earlier excitement after the biggest weekly gain going back to April. We saw the momentum take stocks down, then they came all the way roaring back, and now people are reassessing and saying, what's next? S&P futures up about 0.1%. Dollar is actually gaining versus the yen. Watch this space after last week's intervention, the first coordinated intervention between the U.S. and Japan going back decades. A question here of whether it is effective, given the fact the Bank of Japan may be getting a little more hawkish, but isn't necessarily hiking anytime soon. The 10-year yield rising by about 2 basis points to 4.66% ahead of some auctions as well as key data coming out on Wednesday. And crude up more than 1% with this sort of slow burn in the Middle East. A real question about how much that's going to emerge in Wednesday and Thursday's CPI and PPI reports.
And also, when it comes to Fed speak, are they starting to really look at the fact that we have been in this war for 6 months? We have elevated crude prices. Gasoline is still average above $4 a gallon across the United States. At some point, is this going to become a bigger risk the Federal Reserve just can't look through?
Yeah, how many shocks can you continue to look through if it's shock after shock after shock? 2 hours away from the cash open. Here are your morning movers with Yie-Hsin and Yie-Hsin.
Hi, Lisa. Jefferies is pouring cold water over Apple's 4-day winning streak, with shares falling 1.3% in the pre-market after the firm downgraded the stock. It says its supply chain checks suggest Apple has scrapped that all-glass 20th anniversary iPhone because it was just too difficult to manufacture at scale. And they say that's a major setback for Apple's plans to make more premium, higher priced iPhones as it tries to offset those soaring memory and component costs. Meanwhile, it's a different story at HPE due to some sell side action. We are seeing shares up 5.8% after analysts at Morgan Stanley upgraded the stock this morning. The bank basically saying they got the hardware trade wrong. They thought that soaring component costs would cause companies to pull back their spending. Instead, they say they're seeing companies that demand is holding up as companies basically replace aging infrastructure and spend more as they anticipate prices to go up even further. So 2 very interesting calls out this morning on hardware, with enterprise faring a lot better than the consumer side. And we end on space, with SpaceX shares up 3% this morning, extending a more than 20% gain over the past 5 sessions as that lockup expiration came and went with no meaningful pressure on the stock. We are also seeing Rocket Lab up 3%, and it reports after the bell today. Lisa.
Thank you so much, Yie-Hsin. On our radar this morning, President Donald Trump saying the U.S. is only, quote, semi-negotiating with Iran on the Strait of Hormuz, telling Axios the country is, quote, low-keying it as Tehran battles high inflation and limited funds due to the U.S. blockade of its naval ports. Meanwhile, the Pentagon asking major U.S. defense companies to boost production as shortage concerns arise. The Deputy Secretary of Defense writing in a letter seen by Bloomberg, quote, years-long development cycles are not acceptable, citing programs run by RTX, Lockheed Martin, Boeing, and others. And the AI spending boom powers on. TSMC reporting a 45% increase in monthly sales, signaling continued demand for AI hardware, with revenue for the chipmaker reaching $14.5 billion for the month of July. Notably, that 45% was a deceleration from the prior month. So even though it looks amazing and you are seeing the shares kind of barely moving, that's the reason why, maybe.
That's the reason why. Everyone thought it was going to be a little bit higher, but still, this is an incredible number. And I go back to what Sarah Kunst said earlier to us at the last hour. This is the linchpin of AI. This is the linchpin of AI hardware, and TSMC is still doing well. I mean, it's been down since June, but I think since year to date, it's up some 50%. Everything stems back to Taiwan semiconductors.
And frankly, the incredible CapEx that's being poured into building out AI-related capability. We've already seen a record pace of debt sales. But one thing that people say is that this isn't going to be necessarily the peak. The capital raise peak will probably come next year when it comes to debt sales. So this is only going to continue.
As Dan Ives would say, what are we in? The early innings. I'm glad you mentioned all these companies, though, because I can't get over the fact that they pledged nearly $2.4 trillion when it comes to the data space build out.
Yeah,
unbelievable.
It's something that we've seen consistently, and somebody's got to pay for that. Let's stick with that story. Debt buyers growing more skittish as AI as hyperscalers and developers look to borrow billions of dollars to fund new data centers. Underwriters now spacing out debt sales and signaling a slower issuance pace. Bloomberg's Tassos Vassos joins us now for more. Tassos, give us a sense of just how much pushback there's been to some of these massive $25 billion sales coming out of some of the big tech names.
Indeed, which, by the way, $25 billion, when you used to get it back in the day, it was, once in a blue moon situation. Nowadays, we see that every few weeks. Every time we have a new hyperscaler coming to the market, banks are speaking to investors, and investors are telling them one thing. I'm a bit concerned that this is becoming a bit too much. Because why would I buy a new issue when there could be another massive issue coming around the corner? I can just wait for that, because in the meantime, the new bond that I'm going to buy is going to drop in the secondary market. Nobody wants that. Irrationally, you wouldn't buy a new bond. You just wait for it to drop further. Barclays, the investment bank, asked investors, what do you think is going to drive hyperscaler spreads in the next 12 months? 60% of them said the supply cadence, which they meant the pace of supply. Whether AI is going to play out as an investment proposition was far lower. 25% of investors said that. So we have an immediate threat in the credit market right now, and that is the absolute sheer level of supply from AI hyperscalers.
At the same time, Tassos, a lot of people have pointed out that even though there's been some spread widening, even though investors have demanded more compensation, they're still willing to lend. And frankly, there is only an accelerating pace of issuance on deck, potentially even for 2027. So at what point is it too much for them to pay, or are we not even approaching that level?
Well, what AI companies are doing now, and JP Morgan strategies called it the good news, to quote them, is that half of hyperscalers, whenever they come to the market, they then reassure the market by saying, don't worry, we're not going to do any more until the rest of the year, at least in the US market. And this is what they're trying to do now. They're trying to pace it more so that it becomes a bit more palatable for investors. Because for buyers of debt as well, you cannot escape it, really. AI, at least when it comes to the index and the market as a whole, is sort of the future. Its composition increases, its share of the market increases so much, it's becoming increasingly hard to even avoid it. You can't really avoid it. So the best you can do right now, as a banker, as a borrower, is to space out your borrowings. Otherwise, the market is reaching a level of indigestion.
Yeah, Tassos Vassos of Bloomberg, thank you so much for your reporting. Emily Bannister, the head of private credit at Wellington Management, writing, the bigger the AI opportunity gets, the more selective lenders need to be. This is becoming a market of winners and losers. Emily joins us now for more. Emily, great to see you. Thank you so much for joining us. Emily, what does it mean to be more selective when it comes to AI investment?
Well, one thing to really think about with the AI financing ecosystem that's going on right now is that it is incredibly broad. We are certainly seeing the large data center deals come, but we are also seeing opportunities to finance the AI build out through multiple different lenses. You're seeing it in power generation. You're seeing it in cooling. You're seeing it really across all of the physical infrastructure that will be needed to support AI. And that means you have opportunities to really pick your spots. So when we hear things about one part of the market getting hotter or having a lot of issuance coming in the future, we are also seeing those other seams, those other areas where you can really structure something unique for a need that is supported by the same demand, but may have really different dynamics for a lender. And that's got us very excited about areas like within investment-grade private credit or commercial real estate debt, where you can really look at these themes and then look at the individual structures and investments and find the ones that are going to be the great opportunities for lenders going forward.
How do you immunize yourself, Emily, at a time when we're getting trillions of dollars of CapEx into an investment theme that, yes, everybody believes in, but is murky as far as what the end state looks like and exactly the degree to which it can be monetized? How do you evaluate the type of yield you need to offset the risk, also amid an inflationary moment?
I think you make a great point, which is that not every deal in the AI theme is going to go well. I think that's a guarantee from here, because this is a very broad space. And in many cases, we've seen some thematic ideas in the past where if you identify the theme correctly, you can invest across it and the rising tide will lift all boats and you'll do well. I would say AI is the opposite of that. AI is a place you need to be selective because it's becoming increasingly complex. When we think about underwriting a data center type deal, you need to think not only about the corporate exposure, because it's not only a corporate exposure. You're thinking about the tenant risk. You're thinking about the ability for construction to meet its milestones. You're thinking about what are the opportunities for power generation, how contracted are those? And you're thinking about the structure that you've agreed to and whether it protects you. In addition to your great point, what are you getting paid? What are the yields? So in a complex space like this, really being able to dig in is incredibly important. I think the best way to immunize yourself is actually to have a lens across markets, because this market is also becoming a place where markets are intersecting. We actually did some work on the more than 300 data center deals over the last 2.5 years. And we found something interesting, which is that about a third of those were financed by banks, about a third by the public markets, and then about a quarter by private credit. So this is an ecosystem that is getting financed by multiple different parts of our financing options. And you need a lens across all of them to see where are the structures right, where is the pricing right, and having a full picture across all of them, I think, is the way to immunize yourself going forward.
Emily, you mentioned a bunch of risks when you look at how to invest in AI. What about the political risks? You know, we're sitting here in New York, and there was a moratorium, a ban for a year, basically, on data centers. People don't want them in their backyard, and this is becoming a huge election issue, especially into the midterms.
Well, you couldn't possibly talk about something more fun for a credit person than risk, so definitely a good place to go. But I would say that really gets to the main point, which is that there is incredible complexity underneath data center financings, and each project can look different. They're in different geographies with different permitting processes, with different community engagement strategies. And we do expect that you need to understand what's underneath each deal as opposed to just investing thematically, because that's really where I think lenders can support great projects and do well over time.
Intel just came out and announced a proposed $15 billion stock offering. This isn't just a debt story. This is a financing story across the entire capital structure. We're seeing the shares lower by about 3% in pre-market trading. It just highlights how if there's trillions of dollars necessary over the next couple of years to build out the incredible tech infrastructure, it's going to be required to come from all places. Do these equity issuances, and we've seen this from other companies as well earlier this year, improve the profile of the private credit space, of the credit space overall, or potentially increase the risk of correlation between stocks and bonds to a degree that we haven't seen for a long time?
I think both are important considerations. What we're seeing here is a trend that even goes beyond AI and data centers into really one of the important emerging trends in private credit, which is the interconnectedness of markets. We're seeing increasing convergence between public and private credit. And to your point, we're seeing increasing overlap between issuer exposure in credit and equity markets, and really being able to understand how those are pulling together. And for an investor to be able to look across a portfolio and understand the aggregate risk that they have to a certain theme and to a certain issuer and to a certain credit profile is going to be one of the most important trends going forward for investors.
Emily, just quickly here, how concerned are you about leverage that's building out in the system that was really highlighted by situational awareness, but frankly has come roaring back since a small washout period?
Yeah, in many ways, what I'm seeing right now is a market that is really, because of its maturity and its increasing maturity in private credit, becoming a market that you can't tag with just one brush. So there are pockets of private credit and the overall market where we are seeing leverage increase. There are other areas where we're seeing really modest leverage and where we're seeing really strengthening profiles. And I think the breadth of the private credit market that has now moved significantly beyond sponsor-backed corporate direct lending to really include many other types of financing for assets, for projects, for high-quality companies. You get to see multiple different profiles, and that makes it much more important to be selective. Because there are certainly areas where you'll find stress or leverage. There are also areas where you'll find incredible growth profiles going forward.
Emily Bannister of Wellington Management, thank you so much for being with us this morning. We are seeing Intel shares lower now by more than 4% after announcing a $15 billion stock offering just moments ago. Let's get you an update right now on stories elsewhere this morning. Here's a Bloomberg Brief with Yie-Hsin.
Hi, Lisa. The hits keep coming for Taylor Farms. It's pulling several prepared food items containing jalapenos from retailers over salmonella concerns. The recall spanning more than 24 states sold at major grocery stores after officials linked another distributor, Coast Citrus Jalapenos, to hundreds of illnesses. Meanwhile, TSMC sales jumping 45% in July. The company behind NVIDIA and Apple's most advanced chips posting $14.5 billion in revenue as big tech companies continue pouring money into AI data centers. And Meta introducing a new AI model that can be run on a single computer, allowing users to download and customize the technology. The new Muse Glimmer is a distilled version of the company's Muse Spark 1.2 model. Meta also interestingly announcing plans to set up a $1 billion fund to invest in U.S. communities where it owns and operates data centers, as it gets a lot of blowback. That's your Bloomberg Brief. Lisa.
Thank you so much, Yie-Hsin. Yes, I was just going to say, a fantastic direct-to-consumer lobbying effort. Up next, parsing through data.
It's actually remarkable how unremarkable the data is. I've been pretty adamant about I don't think the Fed needs to hike. I just don't see that as really effective trying to bring inflation down.
Kathy Bostjancic of Nationwide joins next. This is Bloomberg Surveillance. Good morning. Trying to build on what we saw last week, seeing a little bit of a gain, really led by the tech sector, although fading throughout the morning with a 1-2 hit. On one hand, we saw what happened with Apple being downgraded, a rare move coming from Jefferies, and then we saw Intel selling shares. Now, S&P futures almost flat on the day. The dollar gaining versus the yen, crude higher, and so are yields. Under surveillance this morning, parsing through the data.
It's actually remarkable how unremarkable the data is. I've been pretty adamant about I don't think the Fed needs to hike. I just don't see that as really effective trying to bring inflation down. You've got what I would argue is, yeah, maybe it's an okay labor market, but you still need to grow faster. You need to put more people to work. And I think that, to me, is the philosophy that the Fed has to employ today.
Here's the latest. Investors paring back rate hike bets following a surprisingly weak July payrolls report. Wall Street now looking ahead to CPI and PPI data due out later this week. Kathy Bostjancic of Nationwide writing, an easing in inflation pressures can give the Fed some breathing room to hold steady, especially since the labor market is far from overheating. Kathy joins us now for more. Kathy, great to have you on. What are you expecting is enough to take the Fed off the front burner when it comes to moving in September?
Yeah, good morning, Lisa. Well, I think CPI print and inflation prints going forward are really going to be the key. We're expecting a Tame reading on Wednesday, both the headline and the core, 1/10 total, 2/10 at the core level. If it comes in higher, if you start to see 3/10 print on core's CPI and then PPI, misses to the upside and that lines up a strong PCE price index reading, then that puts more pressure on the Fed. But so as long as we get these benign readings that seem kind of tame, I think that does still give the Fed some breathing room and just to wait and see how things play out.
Right now, we've seen the expectation for a rate hike shift down from almost 60% last week to now closer to 40% that they are going to hike rates in September. Do you think that it's surprising that we're even pricing in that much of a chance of a rate hike, given the sort of disinflationary elements of both the employment costs as well as the labor market?
Yeah, I think, the market's a little unsettled here right now, right? It's not that they're missing the forward guidance per se, but they're not even sure the exact reaction function is, was mentioned many times. And really, Chair Warsh even went so far to question what inflation readings we should be looking at. So I think there is uncertainty in the market. I'm not completely surprised it's a little elevated, but from our viewpoint, September seems very unlikely. Unless we get some surprise again in these readings for July. Later in the year, perhaps there's some pressure, but our view is that we do have disinflationary pressures. And I guess we would agree with the sentiment that is, what is the Fed going to accomplish by raising rates, right? They can't solve the energy issue, right? Supply demand, that's coming from the Middle East. AI investment doesn't look like it's slowing down anytime soon. That price pressure is still there. Higher rates aren't going to really make a big difference. And then the same thing with tariffs. So those are the three areas where we're seeing most of the inflation pressures coming. Slightly higher interest rates aren't really going to solve that.
But if you communicate it as you're taking away the insurance cuts of last year, then does it make more sense to hike interest rates?
I'm not sure. I mean, I know I definitely, have heard that argument, but I'm not sure. Look at the labor market, especially the readings. We think it's healthy. I think there's diminished labor supply. So as long as the private sector, we're generating 30,000, 40,000 jobs per month, I think it's still a solid, healthy labor market. It's not dynamic, but it's not overly strong either. So I think, we have to be careful. Those insurance rate cuts may actually be needed for the, Main Street and for the labor market. What's happening in financial markets is very different than, Main Street, and you see mortgage rates going up higher as well.
Kathy, as an economist, last week's Financial Times story, when we learned that Warsh, according to people familiar, would be prepared to hike interest rates in September if you were to see hot CPI. Did that give you some clarity following the press conference?
It did. It did tell us, it gave us some concrete reaction function and the measures of inflation, right? Because he started to question whether CPI and PCE were even the right measures. Maybe there's these real-time measures that the task force is going to bring forth, which many of us, we already know about and watch. But, I think it did give us a little bit of clarity there. Certainly after the press conference, which is a bit more circular in its communication, it was very clear that if inflation, beats on the upside, right, and surprises, then even, Kevin Warsh would be prepared to raise interest rates.
Kathy Wasancic of Nationwide, thank you so much for being with us. And it's something a lot of people have talked about. How high is the threshold for consecutive inflationary reports? This just coming from Andrew Hollenhorst of Citigroup, coming out earlier this morning. Remember, he's calling for rate cuts, 2 of them for the remainder of 2026. His take, a second consecutive month of cooler monthly inflation and year-on-year core CPI falling within basis points of the mandate should help refute the popular idea that inflation is moving further above target and needs to be controlled by potentially tightening policy.
I saw that note. He also, how useful for Andrew and the team was the fact that when you got the jobs print, -20, a revision of more than 100,000 for the prior 2 months, he said also that's at odds with the narrative that the economy is overheating. So potentially, depending on where the data goes, he still thinks that there is this chance that the Fed actually cuts interest rates.
I found that report really complicated because when you look at the internals, a lot of that came from state and local hiring tied to education, and the budgets have been slashed in part because funding is drying up and federal funding in particular hasn't come through. So how much are we looking at a government story versus the private payrolls that actually came in at a pretty healthy clip? I mean, these are some of the questions people are asking, aside from just even questioning the legitimacy of the data.
Right, and also leisure hospitality. You can say the World Cup, there was huge events across the United States, and people are starting to wind that down. So yeah, a little bit murky, and as Kevin Warsh has said, one data point doesn't make a trend.
It doesn't make a trend, and right now people are uncertain of exactly where to go ahead of that data. Coming up, we'll get some certainty from Eric Johnston of Cantor Fitzgerald, Mig Dobre of Baird, State Street CEO Yie-Hsin, and Matt Stucky of Northwestern Mutual. This is Bloomberg.
The good news in that is that you are seeing that broadening out of earnings.
What's happened with this AI trade is that we've extended the duration of equities.
I think the pressure on this market will resume.
You need bulls for bull markets. The question is not, can you get good earnings for 1 or 2 quarters? The question is, can you get it persistently?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to the third hour of Bloomberg Surveillance. Stock momentum fading just a touch throughout the morning after last week's biggest weekly stock rally since April. Heading into the final stretch of the second quarter earnings season, JP Morgan, the latest Wall Street firm to upgrade its year-end forecast. The next test for rates and equities coming Wednesday with the release of key inflation data following last week's disappointing jobs report.
So this is going to be really important when it comes to inflation data, as a number of voices on the Fed have said this has been their primary concern. It's been, 5 years, and this Fed has still been unable to get inflation back to target. Now it seems to be a bigger concern than usual for this Federal Reserve, but inflation data has been cooling. It has been coming down. So if we were to see a hot print, then that would potentially be a bigger concern. The reason why everyone is looking forward to this, though, especially, is because we know that it feels like this is really the function and the idea that Kevin Warsh is just solely focused at the moment on inflation because he's really being pushed around a little bit by some of the hawks in the committee.
And a number of other committee members solely focused on inflation as a preeminent concern. In the meantime, we had seen the tech side of the story really outperform over the past 2 weeks. Right now, seeing a little bit of that backed out after earlier seeing the outperformance continue, and that's because of two names in particular. Apple taking a look at shares lower by more than 1% after Edison Lee of Jefferies said he was downgrading the shares to underweight because of their supply chain checks, which suggests that maybe their all-Apple, all-glass iPhone has been canceled due to low yields. And then Intel coming out with a $15 billion share sale, and you're seeing those shares lower by 3% in pre-market trading. It's sort of both sides. If you don't have CapEx, well, ultimately you can't deliver the actual consumer good. And if you are going to do CapEx, it's going to cost you and dilute the shares.
Yep, and I love this Jeffries note. This is a major setback to efforts to bring in higher-priced iPhones amid soaring memory costs. Have this higher-priced iPhones, you have this higher memory cost. Well, okay, they have this new phone, all glass, no buttons. I don't know. I loved buttons. I loved the BlackBerry. But what's interesting is then, what is Apple going to do? What's the point of buying a new iPhone then if you don't have something new and exciting, which you could see why shares are dropping if they don't think this iPhone is ever going to come to market?
Yeah, you know, it's notable to me, the response in what we're seeing with Intel shares more than with Apple, because Apple's down by, 1% as a result of this downgrade. But you could see Intel and the fear of dilution, especially after how much those shares have rallied over the past 6 months. You can see that the idea of selling more equity just raises the specter that maybe all this CapEx isn't going to be monetized to the same degree that people had expected. You're seeing this in the stock market. You're seeing this in the bond market. Not that people don't believe in the story, but that the cost of it is becoming more real and people are not accustomed to paying for a build out of something like the railroad system.
And it's very, very crowded right now. Everyone is doing this on the equity side and on the bond side. And they're just saying that the money is going to be used for general corporate purposes. Progress in emerging areas, including physical AI, purpose-built silicon, advanced packaging, and external wafers represent significant growth opportunities for Intel. So a little bit soft on the details. Those are a little bit thin, and potentially that's also why people are a little bit like, not so sure about this one.
We're also getting a headline that Anthropic and Macquarie are inking a pact for data center platforms. So again, it goes to the question of the build-out. Right now in equities, we are seeing just a little tilt higher, bond yields tilting higher as well as people take a look at what to expect throughout the year. When you take a look at 2s, 10s, and 30s, it's not just going to be the inflation data, but also some of the debt sales that we're getting this week, the 2s, the 10s, and the 30-year, all coming to market. And then when you take a look at the oil space, inflecting higher as well as people take a look at the ongoing situation in the Middle East. Coming up this hour, Eric Johnston of Cantor Fitzgerald with stocks near record highs after their best week in 4 months. Dobre of Baird downgrading Caterpillar, seeing major headwinds for data center construction. And State Street Investment Management CEO Yie-Hsin as the Fed gears up for a key test on inflation. We begin this hour with stocks and bonds kicking off the trading week. Little changed. Eric Johnston of Cantor Fitzgerald writing, equities will need to battle the negative seasonality over the next 2 months. We think stocks can power through these headwinds and will be led by the tech sector. Thank you so much for joining us, Eric. Now for more, Eric, I just want to start on all of this financing that is expected coming out. We're seeing this from Intel. We're seeing this now from Macquarie and Anthropic. At what point does it get concerning based on just the ability to monetize in quick fashion?
So the amount of capital that is going to be required is clearly going to be, enormous. We're going to see a big step up in CapEx next year to over $1 trillion from the big four. But the bottom line is that what they're starting to show is the ROI, and this is what the market has been looking for. We saw it from Microsoft and Amazon's earnings, where cloud growth has accelerated. And so you're seeing margins expand, and you're seeing rent prices for compute starting to move higher. And so part of this story is about the cash flows from these businesses increasing and likely reducing the need for as much capital markets as people expected before. And so I think that's incredibly important. Now, the reality is that equity and debt is going to be needed, and that's been part of the pressure that we've seen on treasuries, because the amount of paper that's going to need to come to the market from a corporate perspective is going to be very significant. But I think the key point is that you're going to see these cash flows from operations increase, and that will likely reduce the need for the capital markets.
Eric, I just wonder what some of these companies know that we don't. Why are they front-loading all their CapEx now, unless it's a market that is frankly looking really good to them? In other words, they think it's only going to get more expensive for them to borrow, which means that yields are only going to get wider, which means that anyone who's buying in right now is probably going to lose money on a market value perspective, and the same sort of goes for the equity side of things. Why is this such a good time for the borrowers?
Yeah, I mean, they're starting to finally explain how this CapEx is going to work, and talking about how very soon revenue growth is going to exceed CapEx growth. And also the fact that, you brought the point about front-loading CapEx. When they're building a data center, there are parts of the data center that have a 30-year life. There are other parts that have a much shorter life related to the chips. But the point is that the CapEx requirements early on are a lot more than what they are in 2, 3, 4 years from now. And so that's going to likely inflect their free cash flow. We're already seeing it from someone like Microsoft, where their free cash flow this quarter came in higher than what the market was expecting. I think that's a trend that is likely going to continue in the quarters to come. And so that's going to be a very favorable dynamic from a borrower perspective. I would also say that although the amount of supply is clearly very large, and that has been part of the problem around the backup in some of these spreads, but the reality is that their balance sheets are still extraordinarily strong. And a year from now and 2 years from now are also going to be extraordinarily strong, even with all the spending they're doing.
Eric, every earnings quarter, it feels like for these tech names, the bar gets higher that they have to clear. But you think this last season was an inflection point. Why?
So part of it was how they actually handled the conference call in terms of really explaining the dynamics of the CapEx. The second thing is that margins are starting to expand. And so because the demand for compute continues to outstrip supply, pricing is going higher, margins are going higher, and you're also seeing it in the revenue growth. So if you looked, whether it was Google, Microsoft, or Amazon, they all came in higher than what the street was expecting, and the growth is accelerating. So you're seeing revenue growth, for their cloud business, depending on who it is, between 40 and 70%. And the likely scenario is that this acceleration is going to continue into next year. And that's, very, very powerful dynamic.
You're bullish on the momentum factor. You're very bullish on what's going on in the semiconductor sector led by memory. What do you make of Intel this morning?
So this was somewhat expected that at some point they were going to need to raise equity. So their business is a little bit, different than others because of this, foundry build out and this, thought to be able to build foundry here in the United States. And so I think this, the stock is, call it 30, 40% off the highs. And so I think investors were, somewhat expecting this. Ultimately, it's a supply of equity. So I'm not surprised to see the stock, down this morning, considering this supply that needs to be absorbed. But I don't think it's necessarily a indication of what other, for example, semis are going to need to do. Most of them are generating significant cash flow, where they're going to be doing the opposite and actually buying back, shares. So we'll see how this plays out. I do think that the overall equity supply story is a real story, will be a headwind for equities over the course of the next year. And this is an example that's certainly, part of it.
Eric, have we beat any leverage out of the system since situational awareness, or has it all come roaring back in the 4 days subsequently after?
So I think we've certainly have taken a lot of the faster retail money from a global perspective out of the market. Certainly you look at what's going on in South Korea, and some of these levered ETFs are down, 75, 80%. Significant number of brokerage accounts have been shut down. The margin calls have been of, significant proportion. And then here in the US, we saw a major de-risking, not only, from a little bit from retail, but really from institutions who were in this momentum trade. And the momentum trade ultimately is, highly correlated to the AI infrastructure trade. And so I think what we saw was a pretty significant event that we think was a clearing event from both a positioning standpoint for the momentum trade, and it's for a group that it was crowded for good reasons. The fundamentals are really strong, and we think the fundamentals are going to continue to be strong. And so now you have this cleaner positioning that I think is going to allow this group to work in the coming, weeks and months.
Eric Johnston of Cantor Fitzgerald, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yie-Hsin.
Hi, Lisa. President Donald Trump signaling he's prepared to let economic pressure build on Iran rather than launching new attacks. Trump telling Axios, quote, "We are low-keying it and only semi-negotiating with Tehran on the Strait of Hormuz." Iran's foreign minister saying direct talks with the U.S. are not possible for now. GameStop is thinking about withdrawing its $56 billion bid for eBay. Sources telling us here at Bloomberg, the company CEO, Ryan Cohen, is looking into options, including a partnership or joint venture that would enable eBay to leverage GameStop's roughly 1,600 U.S. locations. And Intel is selling $15 billion of common stock. The company is looking to take advantage of renewed interest in its business prospects thanks to the data center boom and its soaring share price. Intel says the money raised will be used for general corporate purposes. Shares down 3.6%. That's your Bloomberg Brief. Lisa?
Thank you so much. Yeah, Intel shares up 175% so far this year, so maybe a good time for them to raise some more capital after that price appreciation. Up next, the morning calls, plus Dobre of Baird downgrading Caterpillar as pushback grows on data center construction. That's next. This is Bloomberg Surveillance.
What's driving higher equity prices right now is that we have higher nominal growth. Higher nominal growth drives higher earnings. If the Fed hikes rates 25 basis points in the midst of all this, is that going to derail the higher nominal growth and higher earnings that equities are seeing? Not at all. That's what we should be really focusing on.
That was Jim Caron of Morgan Stanley, looking forward to a week that is really going to be marked by Wednesday, where we get that we get the inflation read, CPI, and the PPI coming out on Thursday. Right now in equities, we are seeing a little bit of a lift, although basically unchanged on the S&P futures. Right now, we are seeing the dollar gain versus the yen. Watch watch this space as it indicates just how much the intervention last week was or wasn't effective. Yields higher by about a basis points on the 10-year, and Brent higher by 1.7%. What is going on right now in the Middle East? It seems like we're slow walking this, according to President Trump. At the same time, still some skepticism, concern about exactly what's percolating there.
Low-keying it is what he told Axios, which makes me think that the United States is not on the forefront when it comes to these negotiations right now. And when it comes to the reopening the Strait of Hormuz, Iran is having these talks with Oman. But at the same time, they're setting conditions for it to fully reopen that the United States would need to hit, which are not going to happen. So it feels like we're taking 2 steps forward and 1 big step back.
Yeah, what does this look like if this is the new normal? In the meantime, people are shifting their focus to single-name stocks, as that is where the drama has been this year. Time now for the morning calls. First up, Jefferies downgrading Apple to underperform, believing the tech giant will have to cancel next year's all-glass iPhone model due to supply chain issues. Those shares lower by 1%. Next up, Morgan Stanley upgrading HPE to overweight, the firm updating market preferences towards storage over servers and PC. Those shares higher by 4.5% in pre-market trading. And finally, Cantor trimming its price target on Oklo, the nuclear energy company, planning to bypass the utility grid by selling power directly to the customer as it faces a massive AI data center build-out. Let's stick with the data center build-out. Pushback growing across the country. A recent poll from Politico finding that 41% of Americans oppose data center construction within 3 miles of where they live. That is up double digits from January. Dobre of Baird downgrading Caterpillar, citing those political headwinds. He writes, state and local regulations could further limit the ability of hyperscalers to deploy CapEx. This is a recipe for further multiple compression. Mig joins us now for more. Mig, thank you so much for being with us. Interesting that we haven't seen more of this in terms of price targets as a result of the political pressure. What made you act on this now?
Thank you for having me. As you've noted, there's been a very quickly shifting consensus when it comes to public opinion surrounding data centers. And what we've observed in our analysis is that this is a bipartisan issue. It is happening in red states. It is happening in blue states. And what has gone from just local community online movements, now it's becoming more and more of a legislative issues. We are seeing various moratoriums pass at state level. But when you actually look at local level in terms of what various townships or city councils are doing, the regulatory framework is becoming increasingly more difficult for data center development.
We've seen this, though, over the past couple of months, and increasingly this is a campaign issue, and yet Caterpillar just reported results that were incredibly good, robust, and talked about a pipeline that was massive. What makes you think that between now and the end of the year, the political pressure could actually affect that massive pipeline?
Yeah, a lot of it has to do with what is actually going to get built in the future, right? We're talking about 2027, we're talking about 2028. Remember that the results that companies are reporting today or even next quarter are all based on projects that have been approved and started some time back. So the way to really think about this upcoming midterm election, this is likely going to be the first AI data center election and the first of many. With many of these regulations, while not entirely stopping data center development, potentially pushing it out and slowing it down, right? This is a bit like throwing sands in the gears of progress.
At the same time, we do have this Trump administration, which is really doubling down on AI. They want to see the expansion of this trade and data centers. Do you at some point expect the federal government to get involved when you see pushback from states like New York?
I think that's possible, but again, this is going to become an electoral issue for Republicans as well as they consider 2028. So as I mentioned earlier, the thing that's to note here is that this is increasingly becoming a bipartisan issue. And at the end of the day, all elected officials have to be responsive to the needs of the voters. There are ways in which data center development can be done and can be done in a manner that is harmonizing their interests with the interests of local communities. And I think this is probably where the broader framework in terms of how these investments are made needs to evolve.
As we have this conversation, we just got news that Anthropic and Macquarie have formed a partnership for a data center platform. in that press release, Anthropic is saying that they are going to make sure that they pay for the electricity prices of the consumers. Do you think that is the path of travel for these companies? If you want to build a data center, you're going to have to really help the consumers that live around that product.
I think that's absolutely part of it, and I think that's a very good move on their part. Concerns do extend beyond just electricity prices, though. Local communities are concerns with broader impacts that the construction of data centers would have. Everything from traffic to noise to other types of pollution to water usage. So I think this is a multifaceted issue. Electricity is part of it, and I think it's a good thing that's being addressed. But it's only one of the items that have to happen here. And in my view, the most important thing is transparency around all of these other issues.
And Annmarie, to your point, BlackRock also signing an agreement with organized labor for some of its data center build out. We heard earlier of some of what Meta's doing. So clearly there is an eye, Annmarie, toward some of the potential concessions by these companies.
You have to assuage the concerns of the consumers there, because not my backyard is a real thing in politics, and people will go out and fight this, whether it's data centers because they don't want in their backyard because of increasing electricity costs. You have to get local communities involved and for them to see a real tangible benefit in order for you to do this.
At the same time, Meg, yesterday, or I should say on Friday, when we got the non-farm payrolls report, the bright spot was construction jobs. More than 20,000 new construction jobs were created because of this hot area of data center build-outs. We've seen the performance of Caterpillar shares year to date. Are there entities, companies that you cover that you still think are the potential winners of this build out, even amid some potential political pressure?
Absolutely. And let's be frank, data centers do have positive impacts on the communities in which they're being constructed. There's a tremendous amount of jobs, not just in construction, but in other sectors that are being created. As far as my coverage goes, I think the best spot to look is at equipment rental companies like United Rentals, Herc, Sunbelt, Equipment Share. They are all benefiting from mega projects writ large, but from data center construction specifically. And while we are talking about the pace of growth in data centers, the trend towards more construction is not going to go away. And I think that is what's going to benefit all the equipment rental companies and frankly support their growth through 2030.
Mick Dobre of Baird, thank you so much for being with us. And right on cue, Caterpillar Financial announcing a new benchmark debt offering. So, might as well strike while the iron's hot.
Yeah, exactly. But, what Mitch is looking at is basically not this year. And you brought that up. When their earnings came out, they were talking about all this construction for data centers. He's worried about 2027. How difficult is that story and that narrative going to be for 2028? When you have a presidential election, blue and red states both pushing back on this, so their candidates from Democrats, Republicans are going to have to push back on this. It's going to be a very challenging year.
Which you're hearing from a lot of companies. There's a race to break ground before those potential political pressures really build. Coming up, we've got State Street Investment Management President Yie-Hsin looking ahead to a key week for the Federal Reserve and a key week, one of the final weeks of the earnings season. Plus, Yie-Hsin Anand with your morning movers. Shares of Intel sliding on plans to sell $15 billion of common stock. Those shares lower by almost 4%. This is Bloomberg Surveillance. It was a quiet morning, and then Intel and Apple happen, and suddenly there's a data center build out, and it's all the money grab for the AI center. And what you're seeing is the gain that you had been experiencing in equity futures just rolled over a touch. S&P futures now essentially flat. The dollar gaining versus the yen. Watch the space after the intervention last week. Seems to be fading in terms of its efficacy. Yields slightly higher, up 2 basis points on the 10-year to 4.66% on the heels of this. Oil prices rising yet again. 1.4% after an almost 8% decline in WTI last week. 1 hour away from the cash open. Here are your morning movers. Yahira's got them for us with more. Yahira.
Hi, Lisa. We start with Intel. They are falling 4% on fears of dilution after it announced that massive $15 billion stock sale, but you could see why the company is tapping the market now. Shares have nearly tripled this year, and that rally, and it can now use that rally to raise a ton of cash without taking on more debt, so it can invest more at a time when the capital needs are enormous while protecting its investment grade status. Meanwhile, we are also seeing Meta shares rising 2% in the pre-market after rolling out a new smaller AI model that can run on a single computer. It's called Muse Glimmer, and of course comes at a time when the company is spending an enormous amount of money to build out AI infrastructure, and you have investors just waiting for that payoff. So what I think investors are seeing here is that this will get more people using Meta's models today and will eventually generate more revenue in the future. So it's getting a boost this morning. And we are seeing Jefferies pouring cold water on Apple's 4-day rally, with shares falling 1% in the pre-market after the company downgraded the stock. Jefferies saying its supply chain checks show that Apple has scrapped its all-glass 20th anniversary iPhone because it was just too difficult to make at scale, and that this is a major setback for its plans to sell pricier phones in order to offset those soaring memory costs. Lisa?
Thank you so much, Yie-Hsin. Meanwhile, a big week ahead for the U.S. economy, headlined by Wednesday's CPI inflation data. Michael McKee joins us now for more of the alphabet soup that is the preeminent data.
Yeah, Lisa, we have a kind of a slow start to the week, but it's going to pick up on Wednesday with CPI, and that's going to be the most important number of the month for the Fed because they have said they're focused on inflation. Inflation in the pipeline comes up Thursday when we get the PPI. We also get jobless claims on Thursday. We'll see if we continue that run of staying below 200,000. And then we also get retail sales. How's the consumer doing given affordability questions? And Michigan sentiment, we know that'll be depressed, but we'll look for what's happening with the inflation expectations parts of that. Now, the interesting thing about all this is that the numbers for this week are the most important for the Fed, but we're not going to hear much from the Fed at all. Beth Hammack of Cleveland has a couple of appearances. She is going to be talking this morning on Yahoo Finance. But compare this to last year. Last year we had about 9 different Fed events, 6 different Fed speakers. This year, just 2 Fed speakers. It doesn't tell us much about what's going on. Is this because the new chair doesn't want them to talk a lot, or is it just because everybody decided this is a good week to go on vacation? I guess we'll have to wait to find out. But remember, we're only a couple weeks away from Jackson Hole.
Michael McKee, thank you so much. And that is going to be interesting in Jackson Hole, the blank sheet that so many people are talking about. What people are going to do ahead of that is what we want to talk about right now with Yie-Hsin, President and Chief Executive Officer of State Street Investment Management. Yie-Hsin, thank you so much for being with us. Always a pleasure to speak with you. One of the reasons why I love speaking with you is because you can take a look at the flows and just how much people are rearranging ahead of some of this data and, frankly, in the wake of the performance that we've already seen. I'm just wondering how much you're seeing people withdraw cash following the momentum unwind, or frankly, taking cash that they had in money market funds and starting to deploy it in more significant ways.
You know, what we've seen all year is that money is moving into money market funds. It hasn't really shifted, even though the market regime has changed. And I think in large part because expectations of yields remaining at more elevated levels than they've been is attractive, and it's an opportunity to leverage it for opportunistic moves into the market, but it is becoming what we see as a durable asset class.
So it's a durable asset class at a time where people are expecting the Fed to likely remain on hold or potentially raise rates at some point. I'm just wondering what it would take to unlock that $8 trillion in money market funds or wherever it is right now to go into the financing of the data center build-out that we see every single day, with Intel necessarily raising another $15 billion in equity, as they were just announcing.
Well, you know, what we've seen is that investors are really wanting to barbell their portfolios. So they're leaning into a lot of the AI story, where the growth is in the market, and second quarter earnings are a really good example of that. Same time, lots of money are flowing into the fixed income market. But we see asset classes like cash, gold, commodities, private markets as sort of like the anchor to a lot of portfolios. So I'm not sure we're necessarily going to see that much of a shift.
private markets as the anchor for individual, like wealth portfolios or institutions or both? Has that sort of shifted since earlier this morning? Earlier this year, I meant.
Mostly from an institutional standpoint. You know, we've focused a lot on private credit. We continue to see institutions move in large part because private credit tends to have floating rate interest rates. So that's attractive in this environment. Where we've been focused as a firm is really on the investment grade sector, introducing modest exposures into 3 ETFs we launched with Apollo, and introducing private equity, private credit, and real estate into our target date fund series. Modest amounts, 10%, but it adds added diversification and an opportunity for individual investors to take the longest horizon investment that they have and benefit from the value creation we're seeing in the private markets.
When you look at financial markets, and this year alone, do you think it would matter if the Fed raised interest rates? Would that change your allocation?
Not significantly. We are overweight equities today, U.S. first primarily, emerging markets secondarily, and I think it's really on the back of tremendous corporate earnings strength. We think that the economy is in pretty good shape, although from our perspective, we believe the Fed really should hold steady on rates, and that's what we're calling for the balance of this year. But to the extent the Fed does move, and it's already indicated it has a more inclination to move faster, but gradually, we think the economy is robust still, but at the same time, where our worries are on the labor market, and so that's why we view interest rates being steady is the better case.
What are you so concerned about with the labor market? It's been kind of this no hire, no fire paralysis really for a while.
Exactly. And, you know, I think with the Friday report, it showed the labor economy being a little bit weaker. It's not a really strong source of inflation. And it's really that inflation picture that guides us to say this is not a time to be raising rates.
You know, there's a big discussion right now in the Federal Reserve and frankly in markets about artificial intelligence and how inflationary it's going to be versus the productivity boom that a lot of people are talking about. We're seeing, for example, the idea that you are seeing growth continue to accelerate even with some of the inflationary components tied to labor, for example, come in. What are you seeing at State Street in particular of how you're deploying some of the AI tools, the efficiency versus the cost?
You know, I think it is still early days for a lot of companies. I mean, clearly, every single company is investing heavily, as we are at State Street. Where we see tremendous opportunities is with, you know, very significant processes, data-intensive, sometimes very manual efforts, enormous efficiency gains. But we also see revenue opportunities, too, as we think about streamlining our investment process, post-trade, if you will. And then also customizing to clients, being able to provide what we do for very, very large institutions all the way through to individual investors.
We've seen already the financial industry contract a little bit on a headcount front. I just wonder from your vantage point, how you think about the growth of State Street as it surpasses $6 trillion and its footprint, its headcount footprint, in response to the greater efficiency that you can do? Is it just grow the assets by keeping the footprint the same? Is it potentially shrinking the total size of the employee base versus the overall assets?
You know, we see AI as just an enabler, enabling our people to be able to do more. And so we don't see this really as a headcount reduction play, but more so a benefit to being able to serve our clients even better on a global basis.
When will you know that it's fully worked, all of your AI investments that you're putting into the firm? Do you see it now? Do you actually see employees being more productive on a day-to-day basis?
We're gradually seeing it, but as I said, I think it is early days. Once we really see meaningful moves in terms of whether it's margin or revenue acceleration, I think that'll be the time. I expect that'll be maybe a year, 2, 3 years out.
Given that you don't see it as a headcount reduction within State Street, do you see that in the broader labor market as well for other firms?
I think what's happening is that companies are slowing down their level of hiring as they are also undergoing this AI journey and determining ultimately what are their headcount needs and where is that headcount going to be really focused.
Has this summer been quiet for you?
Summer has not been quiet.
Is it normally quiet?
I would say a couple years back it was quiet, but these last couple of years it's been nonstop.
You know, the volatility of VIX has gone down, but are people feeling that way, or are people very engaged and they feel like they're trading on a continual basis?
I think people are incredibly engaged. I mean, these are the kinds of conversations we're having with clients every day. What do we think about the concentration of returns? How do you diversify portfolios? What is the worry that's coming behind what's happening today? How do you protect against it?
Yeah, this seems like it has been a summer that has gone by very quickly on one hand, but on the other hand, I don't know. It seems like every single day is a different story.
It is. You see, obviously, what's going on with the Middle East. You see this massive debate, a change of the guard at the Federal Reserve, all happening at the same time this summer as we head into a really important election when it comes to the midterms.
How would you characterize, Yie-Hsin, the overall temperament of investors right now? Are they optimistic? Are they bullish? Or are they more skittish of the potential risks coming into the second half?
I would say, on balance, more optimistic. Obviously, you know, the concerns about stretch valuations and the amount of financing that's happening on the debt side. But at the same time, you have to go look at fundamentals, and fundamentals are very, very strong. And so from that standpoint, I would say that the concern levels have actually lessened as we've moved in throughout this year.
Yie-Hsin, thank you so much for being with us this morning. Yie-Hsin Hung of State Street Investment Management here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yie-Hsin Anand. Yie-Hsin.
Hi, Lisa. Former President Joe Biden's cancer has spread to his bones and beyond. Biden's son, Hunter, telling the BBC his father's condition is, quote, very painful and debilitating. The president recently announced he is planning to release a memoir in November. Anthropic, Macquarie, and Yie-Hsin announcing a strategic partnership creating Theseus Infrastructure, a new platform to develop, operate, and lease data center infrastructure at scale. The group will identify and build new sites with Anthropic as the anchor tenant. And Minnesota Lynx guard Kayla McBride breaking the WNBA single game record by making 10 three-pointers. McBride finishing the game with a career-high 43 points. The Lynx beating the Dallas Wings, becoming the first team to clinch a playoff spot. That's your Bloomberg Brief. Lisa?
Thank you so much, Yie-Hsin, and thank you for this morning. Up next, setting you up for the day and week ahead. Plus, Matt Stucky of Northwestern Mutual with stocks hovering near record highs. This is Bloomberg Surveillance. Good morning.
When we look at the broader market, we're at essentially all-time highs as of Friday. The employment picture has softened on the margin, but remains relatively robust. We're going to start to perhaps see a shift in the momentum within the equity market, within the AI trade.
That was Kennon of Clear Harbor Asset Management. We've seen a shift since earlier this morning in the market. Earlier this morning, we saw the Nasdaq up as much as 0.3%, now lower by almost 0.1%. You're seeing a similar move on S&P futures, lower by about 0.1% in the wake of a couple of key tech stories. We'll get to them in just a second. The dollar gaining versus the yen, 158.86 after it reached north of 160 last week, inviting in that intervention coordinated with the U.S. and Japan. Question about how effective that was at this point. 10-year yields up 2 basis points to 4.67%. Brent crude higher by almost 2%. Let's take a look at the why behind some of the moves in the tech sphere and why we've seen the momentum lose some steam throughout the morning. Intel, a big piece of this, announcing a $15 billion share sale after its shares were up some 170, more than that percent so far this year, highlighting just the need for incredible capital raise. Right now, those shares, Intel, lower by about 4%, maybe a little bit less at this point. But that, to me, is going to be a key question, Annmarie. How much do you start to get increasing pushback to all the potential capital raises?
Right, and we saw some of that pushback when it comes to companies that were tapping the debt markets instead, and now other companies like Intel tapping the equity market in this $15 billion in common stock. I'm also struck, Lisa, by Kevin Hassett, the president's obvious chief economist, speaking to reporters, says basically the president will decide when the United States sells their
Intel stake. I wonder, seeing a move like that this morning, if maybe they thought, we should have sold it Friday after the close.
At a certain point, you get these 5, 10, 6, 15% moves after just huge run-ups in the names. Counting down to the opening bell, here's a trading diary for the week ahead. Tuesday, tomorrow, we get earnings from CoreWeave and Supermicro, as well as the kickoff of bond auctions. Wednesday, CPI data, the key indicator of the week. Thursday, PPI data, plus another round of jobless claims and Fed speak from Hammock and Barkin. Friday, we get retail sales and the University of Michigan consumer sentiment survey. Traders gearing up for the next big data print, which is going to be potentially the CPI print on Wednesday. Matt Stucky of Northwestern Mutual writing, near-term markets may remain choppy, but we are positive on the immediate term on strong and broadening earnings trends, reinforcing the case for diversification. Matt joins us now for more. Matt, I want to start with just the amount of capital being raised by some of the AI companies, and I want to stay on Intel, the idea that they're going to sell $15 billion of equity, and you're seeing the shares markedly lower in pre-market trading. Do you think this is the path of travel now, when there are new capital raises for the likes of Intel or even the Amazons, Alphabets, and Microsofts?
That's a good question. Good morning, Lisa. Look, I mean, I think a lot of these companies have stretched as much as they can stretch in terms of using all operating cash flows to, further their investment ongoing needs. And so if you want to go beyond that, you have to tap the equity markets and the debt markets. The response to that has been mixed, though. It's, as you're seeing this morning with the price of Intel and how Google's behaved over the summer, there is some pushback on the part of investors. I think part of the concern is sort of what's happened, with companies like Oracle as an example the last few years is, painting a picture of several years worth of negative free cash flows and then hoping that on the other side that there's this big hockey stick higher in free cash. That is an underwriting exercise that some investors just, are pushing back against. I think if you're going to go forward with, that type of financing structure, you have to be able to reports incremental operating margins to the likes of what we're seeing some of the hyperscalers like Amazon, like Google, like some of the others in the space that are posting, operating margins incrementally north of 50%. That's okay. But if you can't point to that direction in the nearer term, it's just a tougher pill to swallow from a financing perspective.
At this point, do you think that there still is a lot of financing to do that is going to be hard to swallow, that is going to cause these hiccups in markets? And I'm thinking, for example, of CoreWeave that's going to be reporting earnings later this week, and potentially, Caterpillar coming to market and selling a benchmark bond offering. I mean, everyone has their hand out. So where are you going to most likely see this indigestion?
Yeah, I think it's going to be more in the fringe players than it is the core players. And here's kind of the reason why is if you're looking at the likes of the largest, most well-capitalized, most entrenched players in the hyperscaler space, let's take Amazon and Google as examples, what you're going to likely see is in the coming 12 months, their monetization levels of their compute infrastructure continue to uptick. And the reason being is that rental prices for GPUs are on the rise, and contracted rates that they have on their books are likely going to be moved higher and mark to market higher. And that's a critical kind of self-financing mechanism that hopefully does kick in, that kind of eliminates some of the stress that's been out there in terms of these financing pressures. But that's the core players. The more fringe players, those are more difficult. The financing costs are higher just due to the balance sheet situation as well as diversification of their profit pools. And so that is going to continue to be probably a little bit tougher sledding for them. But it is a strong market in terms of the demand for compute. And so if you're operating in the space, it's a good place to be running your business, but you are stretching the limit in terms of the financing availability.
What would happen if we were to see higher interest rates in this space?
Well, I think in terms of the ongoing kind of concern about how much more market sensitive this build out has become over the years, I think those are valid concerns. In 2023 through 2025, most, if not all, of the infrastructure spend has been operating cash flow centric. Now as you're using the debt markets and the equity markets to finance more of this, you naturally make it more market sensitive. And so higher interest rates are incrementally going to be somewhat of a headwind on further growth in CapEx. I would say, though, that's incremental, though. The vast majority of the investment that's happening in this space is still financed with operating cash flows. It's just the incremental growth above and beyond that is more market sensitive than it used to be.
Is this what you're primarily focused on as a potential risk for the end of the year? Are there other concerns for you?
I think it's one of the risks. I would say alongside of that, you always need to look at kind of what's happening with the labor markets and what's happening with interest rates. Corrections are almost always sourced from a sharp backup in higher rates or in a higher unemployment rate in terms of where the direction of travel goes for the near term. But if you're looking at just what's really pushed and powered the U.S. economy forward the last few years, it has been the ongoing buildup of artificial intelligence infrastructure. So if there's any kind of wobble in the sentiment or the CapEx growth plans that are there, it naturally pushes some of the economic growth worries higher. Not that they're happening today, but it's certainly in terms of evaluating risks on an ongoing basis, it's something to continue to monitor closely.
So how do you plan to set up heading into CPI on Wednesday? In other words, is this going to be a major data point for equities, or is it more peripheral? Because ultimately, what the Fed doesn't matter as much if it's just one 25 basis point rate hike.
Well, I think it still matters for sentiment. Even if it's only 25 basis points higher. Look, I think that sentiment does have a lot to do with kind of nearer term performance. And so if there is a continued tame kind of inflation reports that we saw similar to last month, that goes for a long way for continuing to diminish the likelihood of a September rate hike. If you look at just the last a couple of labor market reports plus what we saw in June CPI, policymakers are likely to be able to stay on hold if you get another benign report, and that matters for sentiment. And so to me, I think it is still worthwhile to closely monitor those nearer term inflation updates that we're going to get this week.
Matt Stucky of Northwestern Mutual, thank you so much for being with us this morning. And really right now what you're seeing in markets is this push-pull. On one hand, we've seen earnings that have been incredibly positive, and we've seen a bit of retracement coming from some of the high flyers after the leveraged washout, as some people call it, post-situational awareness. And then you have this anxiety about the capital raise that is coming down the pike and whether or not it potentially will dilute some of the valuations we're seeing.
And we're seeing that front and center this morning with Intel, which shares down some 4%, even though they had really an incredible year in terms of this run out. But you bring up this great point. Does this just dilute some of the other shares? And that's really a concern. We saw it on the debt side. Now we're seeing it on the equity side. Yeah, and potentially a lot more going forward, given the trillions of dollars still required, given that we are not necessarily even halfway through the total CapEx buildup required for artificial intelligence. Coming up tomorrow, Marvin Lowe of State Street will be joining us, plus Kelsey Barrow of JP Morgan, Libby Cantrell of PIMCO, and David Tinsley of Bank of America as we count you down to Wednesday's CPI print, PPI coming on Thursday, a slew of earnings and bond auctions, the week just getting started. This is Bloomberg Surveillance.